The Fed is beholden to the inflation data.
Even if we get those rate cuts, we're still in a higher interest rate regime.
We know we're going to eventually get some easing. How much easing we're going to get, we're not sure.
It's a hard equation to say they should be cutting rates.
We all have to keep a very open mind about this cycle because there's no real parallel for it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get your week started live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 negative here by 0.4%. We spent the last 18 months or so staring at the US economy, waiting for recession and totally missing. The rest of the world is already in one. The UK, Japan, Germany, Bramo, China struggling to make this economy stand on firmer ground.
Given the fact that they cut rates, private mortgage lending rates by the most going back to 2019, and the market shrugged. Basically, no one really cared because it wasn't enough to support the economy. Here is the thing. If you've reached the point where people don't have the confidence in an economy, how do you restart some sort of consumer spending cycle that the U.S. is enjoying ad nauseum?
Now, we've talked about this a few times now, Lisa. They are facing what many people consider to be a classic balance sheet recession. They've got consumers that are trying to deleverage, facing the prospect of lower prices in the property market. Lower rates is not going to solve that problem. The issue needs to be addressed with fiscal policy. Now, whether the Chinese authorities actually want to go down that road or not is the ultimate question this morning.
Which is the reason why you're not seeing a lot of conviction for people who go in because it's a trade, not necessarily because they have conviction and some sort of strength in China. I think it's interesting. There were some job cuts over at some of the miners overnight, and really this sort of speaks to a weakness in demand from places like China that isn't resurrecting. And that's the question. When is it going to? Are we reaching a new era where they're not going to support the economy with fiscal?
The difference between the United States and the rest of the world is absolutely remarkable right now. The equity market in the United States just off all-time highs, and M&A picking up. Another big deal announced. Capital One agreeing to buy Discover Financial Services, a $35 billion all-stock deal to create Bramo, the largest US credit card company by loan volume. And the first question I was thinking of was, Annmarie, you tell me, is this one going to happen or not?
Well, it's a great question because what we've seen from the Biden administration is take on a really robust look when it comes to antitrust deals. In December, we saw that there was actually a record for merger enforcement activity from the DOJ, from the FTC. Biden in 2021 issued this executive order about making sure that there is competition in the market. And you have to look at some of the big names that had to unwind deals. Penguin and Simon & Schuster, American Airlines, JetBlue. Does this go through? It's a great question.
But here's the problem. Penguin and Simon & Schuster are not exactly, acmes of strength and growth right now. When you talk about Spirit and JetBlue, again, struggling. When you talk about Discover, having some serious issues. So is this really an issue coming from strength where they want to dominate an industry or to survive? And this is one of the key questions behind a lot of these deals.
I'll throw in another question, Lisa, and we can have this conversation with Amanda Lynham over at BlackRock on credit. All-stock deal. All-stock deal. How many times have you woken up on Monday morning and heard all-stock deal, not debt?
Never debt. And that, I think, is really compelling. This is not a matter of giving somebody a windfall payout because, frankly, this debt market isn't allowing it anymore. This is about something else, perhaps survival, consolidation of different types of efficiencies of scale. We saw that with other deals as well. This is what we're looking at right now. This isn't coming from a place of looking to dominate the industry in some sort of new JP Morgan rival type of way.
This is what I'm looking at right now. Earnings, Lisa, from Home Depot. Let's go through them together. I'll give you the fourth quarter comp sales number, negative 3.5%. The estimate here was negative 3.63. This is the outlook for you. This is what they see for sales in the outlook. The outlook of about negative 1% here, Lisa, against an estimate of positive 0.18%. The stock is down just a touch by 1.2%.
Yeah, and talking about fourth quarter earnings per share missing $2.82 versus the estimate of $3.30. But here's what we've been seeing again and again. Boosting their quarterly dividend by 7.7% to $2.25 a share. We have seen this time and again. Even if the sales aren't there, even if the earnings isn't there, the dividends are going to be there, the share buybacks are going to be there. There's a sense of needing to return capital to shareholders.
That's Home Depot. Walmart coming out a little bit later. Let's turn to the broader price action for you. That stock is down by close to 2%. Equity futures on the S&P 500 negative here by 0.5% on the S&P. The event of the week might not be the data, might Might not be the Fed speak. May well be, Bramo, Nvidia earnings after the close tomorrow.
Entirely. Basically, people are saying that this is going to make or break the sentiment for the entire world markets because this is the fourth biggest company and it really is the future of everything because everyone is AI frenzied and crazy. This is sort of the question. How much is Nvidia one company and how much is it the representation of the AI fervor that has really supported global markets in a way that many people didn't expect?
Stock up big time again year to date this morning, down just a touch by, let's call it 2.5%. Coming up on this programme, Steve Chevron of Federated looking ahead to Nvidia as the earnings report of the week. Terry Haynes of Pangea Policy with pressure building in Washington to deliver aid to Ukraine. And Bloomberg's Ender Karen as Chinese banks look to backstop the troubled property market. We begin with our top story. It's the earnings report of the week, maybe even the quarter. Nvidia reporting tomorrow in the latest signal for big tech and AI. Steve Chevron of Federated expecting growth to expand for the Magnificent Seven, saying this: inflation will moderate, cuts will come, and we think that benefits stocks and will eventually support a broadening out of the equity market from the Mag 7 to other less extended parts of the market. Steve, I'm pleased to say, joined us around the table. Steve, good morning to you, sir.
Good morning.
Nvidia, earnings report of the week or the quarter?
Oh, I think it's the quarter. I mean, look, you've got an earnings season right now that's shaping up to be pretty good. It looks like we're going to do double-digit earnings growth. But if you look under the hood, you've got 40, 50% earnings growth coming from tech plus, and the rest of the index is down, or at least flat. Now, if you look at how that's expected to progress over the year, by the time we get to the fourth quarter, if expectations materialize, we're going to have the rest, the 493, if you will, growing at something close to 20%, while the Mag 7 slow to something closer to 10. So that handoff really needs to occur between now and the end of the year for the market to continue on this rally. We think it will.
A lot of people have been saying that we're going to see broadening out for quite a while. We haven't really seen it.
No.
It's been sort of one step forward, 15 steps back. What's going to be the trigger for some sort of shift?
I don't know about 15, but
okay.
I think we are at an all-time high, Lisa.
Come on, play with me.
I think what you've seen happen is the bond market got ahead of itself, right? When you got in the fourth quarter of last year and the Fed started to pivot, bond yields started to fall, you saw a broadening out. I mean, it's not that tech did poorly, but the rest of the market really started to gain its footing. But then the bond market got ahead of itself. And so now we're pricing back those cuts. We're pricing in a little stickier inflation. We're pricing in fewer cuts. And you see the market kind of retrenching back into the Mag 7. And I think what you really will need to see is those ingredients for cuts to come through. You need the inflation data to participate, which right now it's not. And you need the Fed to start cutting. We think that starts in June. But we view this as an opportunity to buy into those areas.
So dovetail this with Nvidia earnings. Yeah. Is Nvidia's gain everybody else's pain, or is Nvidia's gain everybody else's gain?
No, I don't think the Mag 7 are stealing from the rest of the market. I don't think that's right. I think even when you see a broadening out, we're not expecting, the Mag 7 to be in trouble or to have absolute declines. We just expect those returns to normalize as earning growth starts to normalize and spread out. So, we expect them to be market performers, but some of the other parts of the market that have lagged to start to take the lead.
But amazing for us to see what's happened in the bond market over the last couple of months or so. We've pushed out rate cut calls. Yields are repricing higher, and it's happening for bad reasons, not good ones. It's not just about the strength in economic data. It's about inflation still running hot, CPI, PPI last week. If you just frame last week, yields up off the back of hot CPI and hot PPI, and then equities down what? 0.4%, 0.5%.
0.42%.
Basically nothing, Bramo. Nothing at all. What do you make of that? Is that a disconnect for you in any way, shape or form?
Two things. I'm going to make news here and do something I never do. I'm going to praise the Fed. They've been right, I think, in understanding that some of the goods price deflation was transitory and not overreacting in a dovish way. I think in terms of the equity market, when you take a step back to the medium term, John, you have rates that are likely to fall this year. Maybe it's less than the market was hoping for a month ago, but they're still likely to fall. But earnings that are growing, right? We've exited the earnings recession. It looks like we're going to do 10% earnings growth this quarter. How often do you see a combination for equities where you have rates falling and earnings recovering? It's hard to sell off too hard in the face of those two things.
You understand the worry, though. Do you believe that the Fed's dual mandate is coming into conflict after the data we've seen so far, just last week?
I mean, I think the labor market right now is still strong, and I think inflation is stickier than maybe some folks would have thought. So, yes, it's higher for longer, if you will. But again, from our perspective, we think it's still 2 to 3 cuts this year. It's not 0. It's not the 6 the market was trying to price in. 2 to 3 cuts with earnings growth that's accelerating, that's not a bad environment for equities.
Why is it that you're optimistic about small caps when there seem to be the most leverage to rates?
Yeah, because again, in the short run, when you saw 6 cuts priced into the marketplace and you realized that indigestion was likely, that was our call. I think I was here in January saying the same thing. You can see some downside opportunities there, right? On small caps, on cyclicals. However, if you're a long-term investor, if you're a medium-term investor, and you think that the end state here is in fact rate cuts and earnings growth that is reaccelerating and a recession that's not going to materialize, well, small caps are also leveraged to not going into a recession. They're also leveraged to rates eventually falling, considering more of that debt's variable rate. So we're looking at this and saying, if folks want to throw the baby out with the bathwater, we'll pick it up over the next couple of months, build that position, and we think benefit when rates fall.
So let's talk about the babies. Right now, we're seeing Home Depot lose a little bit because the Home Depot CEO calling 2023 a year of moderation, and they came out with a lower forecast than people had expected. Where are the babies? How do you find them?
Well, I think what you're looking for here is look at the equity market for a second relative to the bond market. The most expensive parts of the bond market are those that are most leveraged to growth, right? Think about high yield and how tight spreads are. Look at the equity market. The parts of the economy that should benefit from a recession not materializing and should benefit from rates eventually falling are cyclicals, it's small caps, it's dividend payers. Those have been the parts of the market that are the cheapest. So again, if you're trying to take a contrarian tilt, which we think you need to do here, you use the weakness in this delay of rate cuts to build positions there, and we think you're going to benefit on the other side.
Elisa, what do you make of that line from the Home Depot CEO that you just mentioned? The year of moderation was 2023. Given the growth we've just had, what would you call 2024?
Well, exactly, given the fact that we had, 5% growth
in the third quarter?
Not bad. I mean, this isn't exactly moderation according to any kind of standard. I'm trying to wrap my head around how much this is specifically a home renovation story and how much this is a broader story. And I'm curious to hear on the call what they speak to with this, how they view the commodity disinflation that they saw to some degree, but also the fact that people were sick of renovating their homes after they'd done that ad nauseum because they couldn't move during the pandemic and they got sick of their walls.
Speaking for yourself here?
No, just
no, not at all. Of course not. Of course not. We'll be following that and the Fed speak, of course. Just a speaker from the Bank of England, Megan Green, longtime friend of this programme over the years, saying the risk of cutting too quickly and then reversing. The risk of cutting too quickly and then reversing. I think that's not just a problem for the Bank of England. Lisa, that is clearly something that weighs on Federal Reserve officials as well.
They've been talking about this. We heard that from Mary Daly last week. We heard that from a host of others. This is the reason why people are pushing out their rate cutting forecasts. At the same time, is this that people are changing their forecasts or just taking off the tail risk of recession? And that's the difference. If people are saying they're not going to cut rates nearly as much because they're worried about sort of reignition of inflation, that's going to be potentially more damaging than just saying we're pricing out the case of recession.
Have you seen the mini Fed meeting taking place on Thursday? Jefferson, Bauman, Harker, Cook, yes. Kashgari and Waller all
I thought
speaking.
of you. Yeah, it's going to be really great. But they're going to be speaking past each other because I don't think they're going to be speaking at the same event. So they can kind of, if they have an issue with somebody, they can kind of angle their
for their own opinions.
Yeah.
So Fed minutes coming later this week as well. So you'll get plenty of Fed speak. Equity futures on the S&P 500, negative here by 0.4%. Steve Chevron is going to be with us through the next 15 minutes or so. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Russia's war with Ukraine is nearing its third year. This morning, the Ukrainian Air Force says it shot down all 23 drones and missiles fired from Russia overnight. A regional governor says 3 people were hurt. Meanwhile, President Biden says he'd be willing to meet with House Speaker Mike Johnson to discuss stalled aid for Ukraine and Israel. Biden says the death of jailed Russian opposition leader Alexei Navalny adds to the urgency of the moment. Shares of Barclays are gaining in Europe this morning. The British bank is going on a major cost-cutting drive and returning billions to shareholders. Bloomberg reports that Barclays is overhauling its operations and reorganizing into 5 new divisions. Those will consist of a UK retail bank, a UK corporate bank, a private bank, a wealth management arm, an investment banking division, and a US consumer bank. China, meanwhile, is ramping up its support for its troubled property sector with its biggest cut ever to a key mortgage reference rate. The PBOC announced that lenders will slash their 5-year loan prime rate by 25 bips to 3.95%. It's the country's first cut since June as policymakers tried to relieve China's property crisis. And that is your Bloomberg brief, John.
Hey, Danny, thank you. Up next on this program, President Biden turning up pressure on House Republicans to pass aid for Ukraine.
We're making a big mistake not responding. Look, The way they're walking away from the threat of Russia, the way they're walking away from NATO, the way they're walking away from meeting our obligations.
That conversation coming up next, live from New York City this morning. Good morning. Live from New York City this morning. Good morning to you all and welcome back to work stateside after the long weekend. Equity futures on the S&P 500 negative here by 0.4%. Yields going absolutely nowhere. 427.33. Under surveillance this morning, President Biden turning up pressure on House Republicans to pass aid for Ukraine.
We're making a big mistake not responding. Look, the way they're walking away from the threat of Russia, the way they're walking away from NATO, the way they're walking away from meeting our obligations, it's just shocking. It's been a while. I've never seen anything like this.
Here's the latest this morning. President Biden saying he's willing to meet with House Speaker Mike Johnson in order to pass the $95 billion foreign aid package stored on Capitol Hill. Pressure is building to pass aid for Ukraine following the death of Russian opposition leader Alexei Navalny in a remote prison on Friday. Terry Haynes, founder of Punchier Policy, joins us right now to talk about exactly this. Terry, let's get straight to the president's response to this, or lack thereof. Does he, in your mind, in your opinion, continue to project weakness to the rest of the world?
I think on Ukraine, John, he has done for quite a while. I mean, you can, I take my inspiration this morning, as many mornings, from the Bloomberg website, and what I get is I get one of your columnists talking about the ineffectiveness of Russian sanctions. Part of my point has always been that they're badly enforced, if at all, combined with late provision of weapons or no provision at all. And on top of that, a lack of being able to use all the tools of the presidency, including the Defense Production Act, to top up stores for both the United States and for allies. And what I get is somebody that has, claims to be as forcefully supportive for Ukraine as possible, but in fact is not being. All I'm suggesting is not a partisan point. I'm suggesting this is a whole of government problem, not just a Democrat-Republican problem.
If he says he's ready to meet with Speaker Johnson, could that mean there's a path for Ukraine aid to get passed in Congress?
I think there's plenty of path for Ukraine aid to get passed in Congress. My basic point on this has been that, process aside, in Washington people love to talk about process, in part because it's easier than talking about substance, is that, and makes us all feel smart too when we're doing it, is that 3/4 of the House is in favor of Ukraine aid, and I could justify that 5 different ways. But 3/4 of the House is in favor of Ukraine aid. It is much more likely than not that this happens. There are a variety of processes to make it happen, from a discharge petition to a suspension calendar to even regular order. But I do think it's likely. Back to John's point, though, I will point out something in Biden's statement that you just gave me. He's willing to meet with Speaker Johnson. Well, why doesn't he demand that Speaker Johnson come on down and sit in the Situation Room and, let's really talk turkey? Why, energy in the executive, which is what's needed here, means you need to force the issue. I don't see a White House trying to force the issue here.
Well, Tina Fordham of Fordham Global Foresight over the weekend was talking about the role that the former President Trump plays, saying, is he more than a president in waiting? Is he some sort of second president? The House Republicans, at least the Speaker of the House, are too worried to call an up and down vote on U.S. aid to Ukraine, because if he did, it would pass. And this is something that really needs clarifying. Is all of this being held back by the fact, Terry, that a lot of Republicans face primaries even before November's presidential election?
The way I would put it is, I think it's very easy to talk about Trump's hold on the party and all the rest, and I'm happy to dispute that to some extent elsewhere. But the way politicians think is they're thinking in terms of their own bases. Part of their own base, and many Republicans certainly, feel that what they need to be doing is providing aid to the border first, and rationalizing the border before they get to any question about foreign aid. that whatever else that is, that's a defensible position. But this is a political reality that nobody's attacking right now. Everybody's staying in their corners, not trying to reach consensus, or more importantly, force consensus until somebody actually does. This Ukraine aid situation is going to be tough sledding.
Terry, there was some speculation over the weekend that the death of Alexei Navalny would turbocharge or sort of restart some of the talks and put new urgency behind aid to Ukraine. Do you buy that at all?
No, sadly, I don't. Mr. Navalny's death, among other things, I think is actually not very much of a surprise, firstly. Secondly, United States foreign policy always gets into trouble when we're rationalizing on the basis of somebody's death. I mean, you can look at Jamal Khashoggi for a rough example of this. The reaction from Biden was to Khashoggi's death was Saudi Arabia was a pariah, and then we were fist bumping with Saudi Arabia, and then we were talking to Saudi Arabia about post Middle East conflict, where we were going from there. Yeah. Now I'm not quite sure where the administration is, but it's Navalny's death is not the problem here. Lack of understanding and willingness to do something about the geopolitical situation is.
Terry, I wanted to squeeze this in. Capital One, Discover Financial Services arriving to the dance party. They want to make something happen. Does this administration let them?
The problem here is that, let me just put it this way, without looking at the merger in great detail. The problem is that the regulatory authorities tend to see 4 weak competitors as somehow preferable to 3 strong ones. And both of those parties, I think, and anybody that's trying to do this more broadly, needs to address that, get over that hump pretty quickly, because what's going to happen is people that don't want the merger to happen are going to use that as a rationale for making it stop.
Hey, Terry, good to hear from you. Appreciate the opinion. Terry Haynes there of Pangea Policy, with us around the table still. Steve Chevron of Federated. Steve, what do you make of that? Not the specific deal, but just the attitude of the regulator to deals like this one going through.
Well, yeah, I mean, look, you're not seeing excess, I think, in the M&A space, just like you're not seeing excess in the IPO markets right here. And so I would agree with what Terry had to say, which is if you've got a couple of weaker competitors that are trying to get together for strategic reasons, for survival, I think you need to look at that closely as a regulator. And in addition, I mean, look, regulators haven't minded the duopoly between Visa and MasterCard. So I don't understand why this is, would be a huge issue. So, I mean, I'd hope they'd be able to see past that.
I guess another way to ask this is, how much do you buy this type of transaction announcement at its face value, that it's something that can go through? Is there sort of a threshold for the value of a deal that you can get behind and invest in versus one that you say is too subject to regulatory scrutiny?
Well, I think you're gonna see that in the stock reaction, right? I mean, you're gonna see, how much of that kind of that takeout premium is priced in, and how much of an uncertainty discount is in there. We'll have to see kind of how the names open up and trade over the next couple of days. But I do think, generally speaking, you've got more regulatory uncertainty here because you've clearly had, politics not involved, an administration that has not been overly friendly to M&A activity, as Annmarie mentioned earlier.
Final question for you before you run. From here until year end, equal weight S&P or market cap weighted S&P?
No, I think it is equal weight. I think you're building that position over a period of kind of Mag 7 dominance between now and that first rate cut. We think that rate cut is probably more of a June event than a kind of May event. And then we think you benefit from that in the second half of the year. If you don't, John, that means something went wrong.
Interesting. Steve, thank you, sir.
Thank you.
Good to see you. Steve Chevron there of Federated. Bramo, we talked a little bit about this last week, that maybe the data and the repricing of rates shocked the market more than it shocked the Federal Reserve. Steve's here sitting in line with the Fed, basically saying 2 to 3 cuts for 2024, and still basically saying this equity market can do okay.
What's interesting to me is so many investors and analysts who've come on the show say that actually they've always been pricing in 2 or 3 rate cuts, that they've never thought about 6 rate cuts. It was that tail risk of a potential recession that was creating that.
That was someone else.
That was someone else, and they were worried about that, but it wasn't me. It's pretty much everyone, which basically means the tail risk has been taken off the table, so let's go.
It wasn't Steve. It was someone else. Coming up on this program, Home Depot earnings and a look at the US housing market. From New York City, you're watching Bloomberg TV. Live from New York City. Good morning to you all. Here's the price action. Equity futures pulling back on the S&P, on the Nasdaq 100, on the Russell 2. We're down about 0.4% on the S&P 500, on the Nasdaq down by 0.6, coming off the back of a very, very minor week of losses on the S&P 500. In the face of a real repricing again in the bond market. Let's go to the 2-year, the 10-year. We're talking about double-digit moves again on the week. And yet this equity market was down not even by 0.5%. This morning we're down 2 basis points to 461.64. The 10 years at about 427.72. But Lisa, this wasn't on really strong retail sales. That was weak. This was off the back of hotter than expected CPI and PPI, which arguably is pushing out rate cuts for the wrong reasons. And yet this equity market was still okay.
People looked at the retail sales. They said, it's seasonal. How many people just shrugged it off and they said that that's not indicative of weakness coming down the pike? It seems like people are completely repricing out the chance of any kind of recession. No one is calling for recession right now. Maybe weakening growth, perhaps, but it's going to be Goldilocks at the same time that you're going to see some of this hotter than expected inflation cool off just a bit. What I find interesting is it is the perfect world for stocks. It is not the perfect world for bonds. How long can that continue before you get some sort of reckoning between them?
That's the ultimate question, and the thing that you and I have been focused on now all year. When you push this through the FX market, it's pretty clear what's going on. Dollar stronger, 5 consecutive weeks of it. The euro a little firmer on the session to 107.94. Let's go through it. The US economy is still okay. Jobless claims dropped lower last week. Based on that, the labour market's standing up to global weakness. Let's put it that way. The UK in contraction. Germany in contraction, arguably recession, if you listen to the latest comments from the Bundesbank. Japan in contraction, in recession. China, deflation, a slumping property market. Strip the US out of the equation, and we'd be talking about a dreadful global economy, a global recession.
Which is the reason why maybe we're not seeing oil prices respond to some of the geopolitical risk because of maybe a lack of demand from other nations that are more industrial, like China. Here is the question. Can the U.S. remain in its own kind of bubble? Everyone who we asked last week basically said, yes, it can. And the reason why? Partly the fact that consumers keep spending. And, oh, yeah, they're spending with fiscal stimulus that keeps getting pumped into the system. And that's been sort of a defining feature of the U.S. recovery was the helicopter money that we talked about during the pandemic.
And seemingly that's what China is reluctant to do. We'll talk about China in just a moment. Under surveillance this morning, our top stories. President Biden's top Middle East advisor, Brett McGurk, will travel to Egypt this week for talks ahead of a possible Israeli assault on Rafah. Israeli Prime Minister Benjamin Netanyahu vowing to push ahead with the operation if hostages held by Hamas are not returned by the start of Ramadan. The Biden administration telling Netanyahu to plan for the evacuation of civilians in southern Gaza. More than 1.4 million Palestinians have sought refuge in the area since the war began. Anne-Marie, things are getting more and more tense day after day.
They are, and I would actually point to this draft resolution Bloomberg has seen from the United Nations. So the U.S. is going to be calling for a temporary ceasefire. This is something they've really been reluctant to do, and I think it just shows how gap their thinking is growing with Benjamin Netanyahu and how frustrated President Biden is with the Israeli cabinet.
But I'm curious how much teeth there is behind this. Is this sort of catering to certain constituents, or is this actually some sort of push to try to get some ceasefire? It's hard to get some clarity here, but it's clear the tone is shifting, whether it's for political or real reasons. It's hard to know.
There's also one line in this draft text, and at the moment it's just draft, but it says such a major ground offensive should not proceed under current circumstances. I think that gives Netanyahu some wiggle room.
It's Elisa's point. Is this really about international concerns for Biden or about domestic issues going into the election?
I think it's about both. On one point, they do want to make sure that they put a lid on what is going on in the Middle East. Look what happened to that vessel the Houthis say has sunk over the weekend. This is the first time that's ever happened. But domestically, massive amounts of pressure on this administration. Look at Michigan. There's a group that voted for him that now has abandoned Biden. And you're dealing with small fractions of the electorate in key critical states.
That's the latest on foreign policy. Let's turn to our next story. This one here. Capital One agreeing to buy Discover Financial in what would rank as the biggest global deal of the year. The $35 billion all-stock agreement would create the largest U.S. credit card company by volume. Capital One will pay a 26.6% premium to Discover's closing price on Friday. The deal is expected to be completed by the end of this year or the beginning of 2025, pending shareholder and, drumroll, Lisa, Regulator Regulatory approval. I think that is the big one right there.
Especially given the fact that Spirit and JetBlue was stymied. You've seen this time and again. This is not an administration that's particularly friendly to big tie-ups. But we've been talking about this all morning. These are not tie-ups of great strength behemoths. This is a tie-up of two companies that feel like they could be a whole lot stronger together and that might be facing some issues, particularly as Discover, without this kind of deal.
I look back at the Consumer Financial Protection Bureau's recent report, though, and I think regulators will hone in on this. Research has found high-level concentration evidence of practices that imply anti-competitive behavior in the consumer credit card market. As we noted in 2023, top 30 credit card companies represent 95% of credit card debt. The top 10 dominate the marketplace. This will clearly be, and they already are, in the top 10. But what I'm saying is an administration that already has not looked friendly on these massive tie-ups and mergers are going to go to data like that to prove their point.
I also just wonder, from a financial point of view, Capital One is one of the biggest subprime auto and other loan lenders, right?
Yep.
If someone wants to cater to lower income families, this is the one that you want to continue to exist and thrive, right? So is this a way to allow them to keep making those loans while getting those prime customers through Discover? That should be a positive. I mean, there are all sorts of arguments for why this should go through. It's just fascinating to me, like we were talking about, that A, this is going through not from a position of strength, and it's all stock deal. Whether it actually gets through, I'll leave that to you to discuss.
Let's just sit on the all stock deal, just for one extra beat. Isn't it kind of funny that the credit card company is financing the deal with equity and not debt? It's like, do as I say, not as I do.
I love that point. That's great. I mean, honestly, why would they want to pay the 25% that they charge?
Well, clearly they don't.
Yeah, exactly.
Which is why first thing I thought about yesterday when I saw the reports on this. Let's get to this story here. China ramping up support yet again for its troubled property market. Banks are slashing the 5-year loan prime rate by 25 basis points to 3.95%. This marks the biggest ever cut to a key mortgage rate. Lenders are looking to reduce minimum mortgage payments and boost demand for falling apartment prices. Investors in China also looking for signs of stimulus ahead of the National People's Congress early next month. Lisa, good luck. I mean, we've been waiting for this for quite a while now. The reopening, go back to, say, more than 12 months ago. China's going to reopen, the economy's going to boom. Just didn't happen. Hasn't happened. Isn't happening.
It reminds me of, literature class in college with Bertolt Brecht and Waiting for Godot and this sort of question of when are they actually going to come to fruition at a time when it doesn't seem like they want to go that route. They also are not giving consistent policy signals with respect to welcoming in international businesses and investors. So at this point, is there a clarity of message or is this a clarity of messaging of what they want to get across? And frankly, this market's not buying it.
You see the latest FDI data?
Yeah.
It's just dreadful. Turn that around.
But I mean, why would anyone want to invest in there? I mean, really, the most bullish people get is it's a good trade because it can't get much worse. That is the most optimistic that people can get about going into China.
Policy just became increasingly unpredictable, and then even more unpredictable. That's the latest on China. Here's the latest on earnings this morning. Home Depot kicking off a busy week of retail earnings. The company reporting a 5th consecutive quarterly decline in revenue on weak demand. Comparable sales fell 3.5% in the fiscal fourth quarter. Home Depot also announcing it's boosting its quarterly dividend by 7.7% to $2.25 a share. Drew Reddick of Bloomberg Intelligence joins us now with more. Drew, let's just go to the headwinds. What are the headwinds right now for this company, and do you expect them to last through the rest of this year?
Sure. So we do think that the environment for the consumer is going to remain challenging through a lot of this year. One of the things that's unique to the home improvement market is that we're still battling a massive pull forward in demand during the pandemic. If you look at the share of personal consumption on goods, you're seeing a reversion to the mean. And if you look even a little bit deeper and look at the portion of personal consumption expenditures related to home improvement specifically, you'll see there's been a pretty sharp drop since peaking early in 2021. So we think that there's a little bit reversion left for the industry as a whole. But in the meantime, the consumer is stretched. You see personal savings rates down a little bit. Credit card balances are rising. So the challenges are still there. At the same time, we're looking at housing transactions that are the lowest since the mid-90s. If you play it out a little bit forward and you do start to see rates start to moderate, you could see a rebound in existing home sales, which would help the home improvement space heading, towards the tail end of this year and into 2025.
Drew, there are 2 points there, and it's important to distinguish between the two. There's one where consumers are getting tired and don't have the cash and are getting stretched given the credit card bills and others. And the second thing is just there's been absolute stasis in the home buying market. this is the question. If rates come down and you do get more transactions, does it matter that the consumer is this stretched, or is this really just an issue about transactions?
I do think it matters. If you look historically, there's been a pretty strong relationship between spending on home improvement projects and moving. And it stands to reason. As you move, you prepare your home for sale, you take on certain projects. Same thing when you purchase a home. You make those improvements after the purchase. We've seen data suggesting that movers spend about 2 times more than someone in their home who is not moving. Now, that relationship has broken down a little bit over the last couple of years because you've had people who are disincentivized to move because they had such a low rate on their current mortgage. You also had the pandemic factor where people were investing more in their home because it took on such a more important role. So that relationship has disconnected a little bit, but we do think that it will resume as we get later into 2024. We do think that a rebound in existing home sales, even though we don't expect them to normalize by any means at this point, we do think it will provide a tailwind.
John, did you hear that? It wasn't just me. He said that basically, everyone
he was talking basically to you.
He was like, if you're locked in
3%
and you're
mortgage.
Exhausted by some of the same walls again and again. I mean, honestly, here's my question. Is this sort of an idiosyncratic story about home building and home renovations, or is this a broader economic story about the ability for consumers to spend? You're saying that it's a bit more of the latter than some people would say.
Yeah, I mean, I think it's both. I do think that the consumer is under greater pressure. And at the same time, I think that the home improvement industry has some unique factors going on because they're so tied to what's happening in the housing market. And, as we've seen over the last year and a half, housing is just frozen at this point, and transactions are completely depressed. And we think that keeps a lid in the near term on demand.
Drew, good to hear from you. Drew Running there of Bloomberg Intelligence. You do wonder, Bramo, we've asked this a few times, do a couple of rate cuts make a difference to this story?
They did, though, in mortgage applications. That's the weird thing. When you
Isn't it
saw
odd?
rates go down about 0.5 percentage point, you saw suddenly mortgage applications shoot upwards. So what's that threshold? Is it sort of a psychological point of 6.5% or 6% on a mortgage rate? I mean, really, if you think about it, doubling where it was when some other people got their mortgages,
Sure.
that,
Some
that you could understand why people might get sticker shock.
It's like having the new Lamborghini on the drive. I was saying this to Tony Dwyer of Canaccord a number of months ago because he casually drops in that he has a 3% mortgage. And that's the biggest brag in society post-pandemic.
Humble brag.
Nothing humble about it. You just sort of drop in, you got a 3% mortgage.
I didn't say that I did.
You basically tell us every week now.
Well, it's okay.
I need rates down 400 basis points and prices to adjust in Manhattan by something like 35%.
Okay, well, we'll
and that'll start to grease the wheels.
For you to get out there and do this.
Just a little bit.
But this is sort of the question. How many rate cuts actually matters if the economy's good? I mean, if you end up, I don't know, getting promoted. Where would you get promoted to? I mean, but like this
is me a promotion.
If you start earning more in this society, then you could, afford it.
I think I've got my annual review a little bit later this morning, so you can come to that with me.
Sure, I'll be right.
We can talk up what it would take for
you to actually be able to buy an apartment, given mortgage rates. I'll prepare you a spreadsheet.
Great, I can't wait.
This is great.
I'm sure my manager's going to love reading that. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Bayer plans to slash its dividend by 95%. It's an effort to dig itself out of a hole created by the acquisition of Monsanto. Bayer says it will offer investors only the legal minimum required under German law, paying out 11 euro cents per share for 2023. The company has faced thousands of lawsuits claiming that Roundup weed killer causes cancer, which it denies. Bayer has already pledged to spend as much as $16 billion to resolve the litigation. Russian President Vladimir Putin may be violating UN sanctions with his latest move to boost ties with North Korea. According to state media, Putin gave North Korea leader Kim Jong-un a brand new car. A Kremlin spokesman says that it's an Urus, a Russian-made alternative to Mercedes. Luxury vehicles are on the UN Security Council's list of banned items for export to North Korea, but there's little the council can do to punish Putin. California is still grappling with extreme weather and another atmospheric river. The National Weather Service warns of difficult conditions through Wednesday after an expected lull today. LA and San Diego are at risk for significant flooding with 5 inches of rain predicted for some areas. The storm is expected to pass through quicker than the one earlier this month. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on this program, China ramping up support for its property sector.
On balance, it's a positive. Yeah, it's bigger than market expected. And the market also looking for a cut more on the 5-year. Overall, it's a positive and should help, but it's not going to change the big picture.
That conversation with Contrarian just around the corner. Live from New York, this is Bloomberg. Stocks are negative here. We're down about 1/3 on the S&P 500 in the bond market. No drama here. Yields going absolutely nowhere. 427.53 on a US 10. The euro is just a little stronger. 108 on euro dollar, positive by 0.2%. Under surveillance this morning, China ramping up support for its property sector.
Sales came down a lot in housing, but the price actually need to fall more to clear the inventory. Either the government set up some state fund to buy over some of the project, or some of the stronger hand have to take over many of those projects and get them built and deliver. On balance, it's a positive. Yeah, it's bigger than market expected. And the market also looking for a cut more on the 5-year. Overall, it's a positive and should help, but it's not going to change the big picture.
Here's the latest this morning. Chinese lenders slashing their 5-year mortgage rate by 25 basis points. It's the first cut since June and the largest on record. The move marks an intensified focus on combating the country's widespread property crisis. Joining us to discuss is Contrarian, Bloomberg Global Economy reporter down in Washington, D.C. And let's start with a downturn in China. Do rate cuts help, or do they need to do something much more targeted on the fiscal side?
Well, I think, look, it suggests some urgency by the policymakers in Beijing, John, moving the LPR by the scale that they have. 25 basis points, that will obviously help mortgage holders, help people get in the market there, and, of course, perhaps at the margin start to turn things around. But as you mentioned, the entire world has been looking towards China over the past year or so, wondering when will they start to turn around the real estate sector. And I don't think this move in and of itself will be enough to do that. You saw the market reaction pretty muted. You hear what the economists are saying in response to it as well. A short-term, cuts to the near-term money market rates won't be enough to turn it around. It's going to require a much bigger bang-style approach, I think, from the authorities to get the real estate sector back on its feet.
And we've been talking about this for a while now. In your experience, your coverage of Japan all those years ago, are there echoes of the balance sheet recession that plagued Japan playing out in China currently?
Well, that's one of the big talking points between China and Japan. Debt, however, does continue to grow in China, John. That's one of the key differences when it comes to that debate. China, no doubt, is battling deflation right now, though, and it's in a much worse position than it was, we'll say, this time last year when people expected that post-COVID rebound. And that's been one of the big surprises, I think, for the whole world when you're looking at China at the moment. It's just not just that it's in a slump, but it's how long it's taken the authorities to kind of intervene and take the kind of big steps or big measures that would once have been expected by China to turn that around. And it's feeding this narrative that maybe the authorities are now more focused on, we'll say, on the security side of things rather than on juicing growth the way they once would have in the past. And by the way, we just had a Chinese New Year holiday, and the readings that were pretty mixed as well, suggesting that things in China are still fairly subdued. We do have the NPC coming up. That's the all-important gathering of the officials in March. That will give us the next big readout on where the Chinese economy might be going over the coming year.
With the Lunar New Year, I did notice that the number of travelers, though, to Hong Kong surpassed what we saw pre-pandemic. Are Chinese travelers spending more domestically than they were internationally?
Well, so the travel did rebound, Annmarie, over the New Year holiday, both domestically and into Hong Kong and down to Singapore as well. But the spending did not rebound. A fairly mixed picture on that. Goldman and Nomura did an analysis on that, suggesting that actually the spending remains below the pre-pandemic level. And it speaks to the idea that there might be some recovery at the margins. People are starting to get on the high-speed train again, or getting a plane to go around to some of these countries that offer visa-free, relations with China. But they're not spending the way they were in the old days. So this goes back to the idea that the animal spirits in China remain subdued. There's no real sign yet of a turnaround. And even with this move that we saw last night with mortgage rates, nobody expects that to turn things around either. But the big question is, when will the authorities pull the levers that do inject confidence into the world's second biggest economy? And it doesn't feel like we're there yet.
Also subdued was foreign direct investment, the lowest level we've seen since 1993. Do you expect this to continue given all the geopolitical concerns regarding Beijing?
Always tough to get a very clean read on FDI data because you can slice and dice it in different ways. But I think broadly speaking, Annmarie, there's no doubt that investor sentiment towards China is in a much more negative space than could have been possibly imagined even a few years ago. Even if multinationals are not pulling out of China, neither are they expanding or necessarily growing their investment there. And we hear continued warnings from the chambers of commerce representing the big industrial nations about, their members not necessarily being gung-ho on further investment into China. Of course, money continues to go in. Of course, it goes into pockets. But there's no doubt geopolitics is weighing, and that is forcing companies to look elsewhere. And that's why money is going to other economies now, like, say, Mexico, Vietnam, your Poland's and Morocco's. They are gaining when it comes to how geopolitics is impacting the flow of money around the world.
There's a real question, of what kind of stimulus they could do, fiscal stimulus, that could really reignite some sort of growth, optimism at a time where they've got enough bridges to nowhere, enough villages that are empty, and a shrinking population. What are you looking at in terms of fiscal stimulus that could actually do something with respect to bolstering confidence and growth?
I think measures that would really rev up the real estate sector is probably the one, because it's such a multiplier in that economy. Economists, you can argue the difference, but maybe say between 20 and 25% of overall activity comes from the real estate sector. So if they can go in there, Lisa, and either clean up the banks or clean up the property developers and inject capital into that side of things, I think, you'd hear a lot of people say that China's economy would start to turn around fairly quickly, given the vested savings that there are among homeowners in the real estate sector. That would start to turn the ship around. As I say, we do have this big gathering coming up in a few weeks in March, the National People's Congress. That's where we get the readout on the growth target for the year ahead. And we'll get the readout on what they plan to do in terms of government spending, borrowing and spending. And I think there will be a lot of focus on within that, what are they going to do about the real estate side of things?
I was struck by Anglo-American, the British company, the miner, that came out and said that it was cutting 3,700 jobs because of some of the declines in precious metals and other costs. I keep wondering how much this is directly related to China, how much a lot of the commodity sector has been suppressed simply because China has not been there as a source of demand. From your point of view, how much is that really the story, that the commodity sector is a read on the weakness and lack of building in China?
Well, this is a confusing one because, Lisa, on paper, I totally agree with you. That's what the textbook 101 would suggest. But through all of China's slump last year, iron ore held up. Iron ore at one point was trading over $100. I don't know what it's trading at the moment. But, 101 used to be where iron ore went, China's economy was going. But it's held up. So it speaks to the idea that there is investment going on, commodity demand investment going on, parts of China's economy. They are spending on infrastructure, especially at the local government level. For sure, it's not the kind of gangbusters commodities boom driven boom by China that we've known, say, over the past couple of decades. But there certainly is demand, and I would point to iron ore as one area whereby China is sustaining that market.
And can we just finish on the compare and contrast with the rest of the world? We've got a downturn in the UK, in Japan, in Germany and elsewhere. How different are those stories compared to what is playing out currently in China?
I think some differences. I mean, remember, post-COVID, China is disappointed. I think, as we say, John, a lot of it there is geopolitics and the real estate sector. The UK and Germany, of course, have been on the brunt, I think, of the energy spillover from the impact of the war in Ukraine. That's been part of the story there. There are different idiosyncratic factors, but, no doubt weighing all of this, I will say, is the geopolitics, is the idea that the world is a much more fragile and tense place than it was, say, a decade ago. And I think that is keeping a lid on activity in some of these industrial-led export nations, John. And
thanks for your response this morning, buddy, as always. Bloomberg's Ender Curran there on the latest in the global economy, China specifically and elsewhere. You add it up, idiosyncratic or not, Lisa, it adds up to a global downturn.
Especially given the fact that the only source of growth is the United States. And a lot of people are expecting the great moderation that was 2023 at 5% GDP growth in the third quarter to actually be moderation later this year, which is the reason why the Fed will feel comfortable enough to cut rates.
I think it's fair to say it's the great moderation for the Home Depots of this world.
100%.
And maybe not for the broader economy, with unemployment still south of 4%.
Which is part of the reason why it's been so difficult getting your arms around this. Home Depot might be struggling. Hermes scarves, maybe not.
Better than good. We'll see if Walmart's doing okay in about 5 minutes' time. Coming up on this programme, Sam Stovall of CFRA, Joe Feldman of Telsey Advisory Group on the latest in retail, Liam Mallon of ExxonMobil, a conversation you do not want to miss, and Amanda Lynham of BlackRock, that and a whole lot more. The stage is set as follows going into the opening bell a few hours from now. Equity futures on the S&P 500 pulling back by 1/3%. Yields are going absolutely nowhere, 427.72. This week, a sprinkle of economic data, a ton of Fed speak, and the number one earnings report of the quarter. Tomorrow, after the close, Nvidia, just about 36 hours away. This is Bloomberg.
The Fed is beholden to the inflation data.
Even if we get those rate cuts, we're still in a higher interest rate regime.
We know we're going to eventually get some easing. How much easing we're going to get, we're not sure.
It's a hard equation to say they should be cutting rates.
We all have to keep a very open mind about this cycle because there's no real parallel for it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market pulling back just a touch on the S&P 500. Let's pick out a single name, a rather big single name. Nvidia, year to date before this morning, up by 46.63%. We're only, 6-7 weeks into this, Lisa, after a massive move last year.
Why not buy it? It seems to be the sort of feeling right now because not only do they beat, but they'll beat by 10, 20%, maybe 30%. I mean, go figure. Here's the question. What's going to be considered a beat by Nvidia when it reports tomorrow? Is it going to be just simply getting above the expectation on the street, or is it going to have to be smashing it out of the water like they've done a couple earnings in the past?
You've got to beat by double digits and raise.
Exactly.
And then beat by double digits and raise. And this market's priced for that, isn't it?
I mean, basically, you're looking at the fourth biggest company by market capitalization in the world that has gone from a company that nobody's heard of to basically the entire market. So here's a question. How much does it really shift the narrative single-handedly versus just be sort of in an echelon of its own that people can look past?
And do you think it de-emphasizes the importance of monetary policy? I mean, let's get into that a little bit more, because based on what we expected to happen, let's go through it. Data comes in hotter than expected. CPI, PPI last week. Yields are just higher again for another week. I think 3 weeks at the front end of the yield curve. And yet equities are doing OK. Got to wonder why. Is it about monetary policy, or maybe it's not at all? Maybe it's all about the earnings of some big powerhouses like this one, Meta, another one, which is just powering this equity market higher and higher.
Well, that's what David Kostin over at Goldman Sachs was saying, that basically this is entirely an earnings-driven story, which is the reason why he's revising upward his S&P forecast for this year for the second time since November to 5,200. That's only an upside of 3.5%. So how much further can you potentially see some of these forecasts go? Here is the issue, though. Can this market hinge on the gains of just a few behemoths? Or do you have to see a broadening out? I mean, this sort of goes to a question of, at what point do other companies benefit from the AI boom by creating efficiencies, et cetera? I mean, is this basically a pipe dream that's 2 years out, or is this going to be something that we're going to see monetized in the next 6 months?
Walmart numbers just dropping across the Bloomberg. We'll go through the headlines in just a moment as we chew over them. I just want to bring up David Kostin. David, let's catch up soon. Let's go through these numbers.
Please.
November, the price target, 4,700. December, new price target, 5,100. Let's wait a couple of months and see how this plays out, Bramo. New price target, 5,200 over at Goldman.
And it's entirely on earnings, basically saying that they're coming in better than expected. 79% of companies have beat expectations so far on the S&P that have reported. Again, though, you have seen this dominated by the big tech players. You're not seeing it to the same degree in some of the small caps, which is the reason why it's been a tough sell. And you see that time and again. So
let's get to the numbers from Walmart. We can deal with the results, the outlook, and there's a deal in the mix as well. So let's deal with the results first. Fourth quarter revenue, $173.39 billion. The estimate, $170.66. Adjusted EPS for the quarter, $1.80 against an estimate of $1.65. A deal, Lisa, that we can talk about in a moment, but let's go to the outlook as well. They see 2025 adjusted EPS of $6.70 to $7.12. The estimate, a little north of $7.
So they're beating expectations, but I'm curious about exactly why. And we're going to dig through exactly whether this is because of better pricing power, whether this is because of what you're seeing from lower-end consumers. I'm also interested in this Vizio deal. And we're seeing Vizio shares jump 13% in response to this offer from Walmart. This is a television production company, right? This is basically a company that designs and sells TVs, viewer data, advertising. What is Walmart looking to do right now? I'm curious, is it more interested in the hardware, or is it about the data and the advertising and capitalizing to become a real rival of Amazon and some of the others, the conglomerate kind of sphere? Also, it's all cash.
Looking to buy that deal in cash. Plans to finance the deal with cash and or debt. I've seen that headline just drop right now. Either way, it's very different to what we heard from Capital One and Discover a little bit earlier this morning.
But it's also coming from a point of strength. And this is the difference between the Capital One and Discover deal. Not as much strength. That is trying to become a stronger player. This is trying to dominate. And that, I think, is notable because this is basically a company that is looking to really be competitive with the big tech players. This is one of the biggest hirers of tech staff, actually. So Walmart's playing a real interesting game here.
Completely different story over at Capital One and Discover Financial Services, a $35 billion all-stock deal. AMH, number one question for so many people looking at this deal this morning is whether the Biden administration will ultimately give it the green light to go ahead.
Well, the mood music in Washington, D.C. when it comes to these big mergers is that no. When you look at the DOJ and the FTC, Matt Schultz over at LendingTree had this to say, saying, given this recent challenges of Discover, will this be what Lisa's talking about, a white knight coming to help fix this troubled player? Or will the market view this as it means less competition on the board? Will the Biden administration look for that and then say this is void?
Discover right now up by, let's call it 15% in the pre-market. The broader market looks like this on the S&P 500, pulling back by, let's call it a third of 1%. Yields repriced higher again last week, this morning, just a touch lower, 427.53. Lisa, it wasn't about stronger output. Retail sales disappointed. This was about hot CPI and hot PPI. I would argue, I think Stuart Kaiser of Citi mentioned the same thing in his note yesterday evening, that we're pushing out rate cut expectations on the back of that for bad reasons, not good ones.
And Stuart Kaiser was saying, good news is still good news, guys.
Kind of whispering it.
But we're going to think about this going forward, about maybe at some point good news becomes bad news if we're not talking about the good news actually being retail sales coming out. And I will just dovetail this into a little bit more color from the Walmart earnings, where they basically did reduce their forecast and talk about the softer, sort of more selective consumer. So this might be not just a one-off that has to do with seasonals, but a longer-term story. Does that play into the strength that people are betting on?
If we had the audio version of Stuart Kaiser's notes, which we don't, but if we did, the tone would be different yesterday, right? I think he probably would have used that voice.
I think so, given the fact that he was saying for now, right? Good news was good news unabashedly. He would come on and say, just cut it out with this good news is bad news crap. But then he's basically coming out and saying, for now, maybe we have to see. And I think that's a shift.
That was not the optimal mix in the data last week. Let's say that for sure. Coming up on this programme this hour, here's the lineup for you. Sam Stovall of CFRA, with the S&P coming off its first week of losses since early January. Joe Feldman of Talcyon, Walmart and Home Depot earnings. Amanda Lynham of BlackRock as the Fed hones in on commercial real estate. We begin with our top story this hour. Hotter than expected economic data snapping 5 weeks of gains on the S&P 500. Sam Stovall of CFRA writing this. Market volatility has been consistent with the S&P 500 returns after eclipsing large round numbers. Short-term declines have typically occurred, but they have been fairly short in duration. Investors would be wise to view them as reasons to buy and not bail. Sam joins us now for more. Sam, get into that for us. Build it out for us a little bit more. Why buy here and not bail?
Hey, Jonathan, good morning. Well, I don't really think you should bail unless you have a crystal ball that says when we're going to be seeing the peak in prices and that the decline would end up being relatively shallow, because traditionally what we find is that the S&P advances another 2 months after recouping all that it lost in the prior bear market before stumbling by about 8%, but then advancing once again. And if you look at other historical indicators, such as the market being up in January in an election year, full year has been higher 100% of the time since World War II. All-time highs in January and February has increased the average price by almost 2 to 1 for the full year and increased the batting average to 88%. So there are several other indicators that basically say, okay, this market could end up being strong this year. But the timing is that, maybe we do end up with some sort of digestion of recent gains, but that would probably end up being a buying opportunity for the strength that I see occurring in the final quarter of this year.
Is a drop of 0.42% a buyable dip?
of 0.42%.
That's the decline of last week, which is basically the first week in 6 that you saw declines, and the second week down in the past 16 weeks of declines. That's the kind of negativity that we're talking about in a market that seems to be going up. So how do you identify a dip that's even viable?
Well, that's true, because when we did have that 0.42% decline, you recall the day after the S&P 500 set its 11th all-time high in this year-to-date period. So investors thought, even in the very short term ahead of earnings reports, that this was a buying opportunity. But I think that there will end up being a bit more of a digestion of gains in the period ahead. I really sort of see the market sort of undulating between maybe the 5,100 level, 4,800 level, really just giving investors time for the earnings to catch up to the multiples, et cetera, before we advance further once the Fed does finally cut interest rates, because I think that they are sticking to their slower to lower interest rate mantra.
Sam, there have been a lot of conflicting data points. Last week we got, as John was mentioning, weaker than expected retail sales, but harder than expected CPI and PPI, raising this question of the wrong kind of inflation. Today from Walmart, we get commentary about a more cautious consumer, with the CFO saying they are being choiceful and talking about how there's going to be a little bit more caution expressed in their shopping habits. Does this give you pause to something of a greater weakening than maybe people are recognizing?
No, I don't. I think it's management's job to manage expectations. This will end up being the 57th quarter out of the last 59 in which actual results have exceeded end of quarter estimates. We entered the quarter thinking we were going to see earnings up by about 2%. Now earnings are expected to be up by 5.3%. And consumer discretionary category is expected to show improvements not only for the fourth quarter of 23, all of 23, first quarter of 24, but also we're seeing improved outlooks for all of 2024. So what we're really seeing is management doing their job.
Sam, you've touched on the earnings mix. Let's go to that and talk about the contribution coming from the Magnificent Seven. How vulnerable is this equity market to just a bad earnings report from Nvidia after the close tomorrow?
Well, I think there is vulnerability there, not only with Nvidia, but also just tech in general. Historically, whenever we have been bumping up against that 30 multiple on forward 12-month earnings, basically tech itself has stalled. But the real question is, will we end up seeing an improvement in participation rates? Right now, whether you look to the 50-day, 200-day, or combination of both, we are now back above average for all of the sub-industries in the S&P 1500. So participation is there. 54% of the stocks in the S&P 500 are positive on a year-to-date basis. So we are seeing contribution, but the true leadership is coming from the Magnificent Seven, the Sensational Six, the Fabulous Five, whatever you want to call them.
The number's getting smaller and smaller, Sam. Sam, it's good to hear from you. Sam Stovall there of CFRA, looking ahead to Nvidia earnings and a whole lot more after the close tomorrow. If things are improving elsewhere, if you can identify these pockets of improvement, Lisa, those voices are getting drowned out by monster gains again in stocks like Nvidia.
The overwhelming one. I'm trying to think of all of them.
Sure.
There's terrific too. I mean, but this is basically, how much can you whittle it down to one name that can make or break an entire market? And I guess we're going to see that tomorrow.
That one name seemingly at the moment, for some at least, is Nvidia. And those reports, as Lisa suggests, come after the close tomorrow afternoon. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Capital One has agreed to buy Discover Financial in a $35 billion all-stock deal that creates the largest U.S. credit card company by loan volume. The price represents roughly 25% premium on Discover's last close. Capital One says the deal will help build a payment network that can, quote, compete with the largest payment companies. The deal is expected to be completed by the end of this year or next. It would be the biggest global deal of this year so far. Russia's war with Ukraine is nearing its third year. This morning, the Ukrainian Air Force says it shot down all 23 drones and missiles fired from Russia overnight. A regional governor says 3 people were hurt. Meanwhile, President Biden says he'd be willing to meet with House Speaker Mike Johnson to discuss stalled aid for Ukraine and Israel. Biden says the death of jailed opposition leader Alexei Navalny adds to the urgency of the moment. The U.S. has proposed a UN Security Council resolution warning against an Israeli assault on Rafah and calling for a temporary ceasefire, according to a copy of the draft text seen by Bloomberg. So far, the Biden admin has been reluctant to take steps against Israel, but frustration with Benjamin Netanyahu's government is growing. That's your Bloomberg Brief. John.
Danny, thank you. More from Danny a little bit later this hour. Up next, the consumer showing signs of weakness.
You can certainly see that there is some stress on the low-end consumer. You're seeing delinquencies come up on credit cards. You're seeing auto loan delinquencies come up. There is stress in the low-end consumer, but right now the higher-end consumer is still consuming.
The latest on Home Depot and Walmart. Up next. Stocks pulling back just a touch. We're down about 1/3 on the S&P 500. This from Andrew Hollenhorst of Citi just moments ago. Soft landings are unlikely precisely because inflation forces the Fed to hold policy rates higher for longer. That part of the story last week as yields repriced higher this morning, just a little lower on a 10-year 427.33. Under surveillance this morning, the consumer showing signs of weakness.
You can certainly see that there is some stress on the low-end consumer. You're seeing delinquencies come up on credit cards. You're seeing auto loan delinquencies come up. There is stress in the low-end consumer, but right now the higher-end consumer is still consuming, and so therefore you don't see that balance isn't there yet quite. But I think that there's some real stress under the hood of the system, and I think that's where you have some real tension going forward.
Here's the latest this morning. Shares of Home Depot falling today after reporting a 5th straight quarterly decline in revenue. The CEO calling 2023 the, quote, year of moderation. Meanwhile, Walmart offering softer guidance. The world's largest retailer saying consumers are being, quote, choiceful and expecting sales growth to slow for fiscal year 2025. Joe Foundman, Senior Research Analyst at Telsey Advisory Group, joins us now for more. Joe, let's start with Walmart, a question that we love to ask on this programme. If they're doing well, is the country doing poorly? What's your read on that?
Yeah, I do think that, Walmart has been doing very, very well. They certainly seem like they won the holiday season, and the consumer has been trading down. I mean, we do continue to see that. And I think Walmart's strength reflects some of that. It doesn't mean it's all bad for the consumer out there. I do think that the consumer is choiceful, as Walmart said, and it has been able to spend where needed. We've seen unit sales, actually, of some of the discretionary categories were increasing during the quarter, even though food and essential goods were really the driver. But we did see some pretty good strength, and you're seeing continued traffic in positive territory at Walmart.
I remember the last earnings season where Walmart shocked us all by talking about outright deflation. And we said, oh my goodness, we're going to enter this deflationary spiral. And now they're saying, maybe not so much. What do you sort of see as their pricing power and their ability to look past some of the weakness that we saw last year that seems to have shifted, particularly in the goods sector?
Yeah, I think Walmart always tries to lead on price. We do pricing studies on a very regular basis, and Walmart is always the lowest price. So you're going to get the best value there for whatever it is you're shopping for. And I think that they're going to continue to do that. And I think what we're seeing this morning from Walmart, from Home Depot, and what we'll see over the next couple of weeks with earnings is 2024 is looking to be more of a year of normalization. And the year starting up, probably going to start somewhat soft and hopefully pick up a little bit as it progresses, as we start to normalize with inflation, deflation issues across different product categories, and then kind of get back towards a more normal split between essentials and discretionary goods.
Not to be existential, but what is normal? And I ask this at a time where Walmart is really trying to compete more directly with Amazon. Who is its biggest competitor right now? Is it the Targets and the Home Depots of the world, or is it Amazon?
I think Walmart would tell you they're competing with everybody on a daily basis. It's been very interesting to see them compete against Amazon, though. Walmart's e-commerce business was very strong during the quarter. They continue to execute really well. And, they're competing day to day, depending on the category, with really everybody out there, whether it's Target, even Home Depot, Amazon, and they're competing quite well. So we're really pleased with what we saw out of Walmart today. And I thought the guidance for 2024 was actually pretty solid as well.
It's buying Vizio. So to Lisa's point, there was a question earlier about whether Walmart is actually after trying to sell smart TVs or it's looking to learn more about consumer data. What do you think?
My guess is they're probably trying to get more of the data side of things, and they're trying to learn more about the customer, have better access to the customer data, and then be able to leverage that for some of their advertising business. Clearly, it'll be a big question on the earnings call this morning at 8 a.m. When they do speak with Wall Street analysts. Certainly something we'd like to know more about. Obviously, selling Vizio TVs is a big part of it as well. I mean, I think Vizio has about 8% of the market share of TVs out there. So it's a good chunk of sales that they can drive business with.
Joe, can we turn to Home Depot and talk about the headwinds that you've been talking about for a while now facing that company? How much of their situation is out of their control?
Yeah, I think a good amount of the Home Depot issue, and Lowe's for that matter, maybe Floor & Decor, we'll see in a couple of nights, is out of their control. I mean, it really does relate to the fact that where the consumer's at. The consumers did a lot of spending on the home during the pandemic. We're coming out of that. They're making choices where to allocate dollars, and it is shifting back a little towards discretionary, or is expected to in 2024. But the home has been an area of weakness. Home furnishings, home improvement, other than just kind of the maintenance that you're doing on a day-to-day, Home Depot and Lowe's, I think, are going to face some challenges in the first half of the year, as consumers are still avoiding heavy investment in the home at the moment, just as they're trying to, get food on the table and kind of get back to a normal level of purchasing.
So we've been talking all morning about how this market has been entirely dominated by the Magnificent Seven, Six, whatever you want to call it. And this raises a question: when are we going to start to see some of the artificial intelligence gains play out in places like retail? And some of these companies that are searching and buying the data and looking to try to monetize that in a whole host of different ways. What are you seeing on the ground in terms of how much that's shifting productivity, as well as being able to offer new streams of revenue for some of these retailers?
Yeah, I think artificial intelligence, or especially the generative AI in particular, is really starting to come into the fold. I think it's still early days for a lot of retailers. Walmart in particular is on the forefront of it, though, and we are starting to see them use it on a regular basis within their supply chain and their network. So you should start to see some of that in profit improvement, I think, in 2024 and beyond. That being said, I think most retailers would tell you it's still early days. I think they're finding ways to leverage it on the consumer-facing side. I think better chatbots, better wayfinding within stores, better service levels can come from AI. But again, I think it's a great buzzword. I think it's going to be some time before we really see productivity from it. Probably later this year. 2025, 2026 and beyond is where you'll see more of it coming.
Joe, can we finish with your top pick? What is your top pick this year?
Well, I mean, it's hard to bet against Walmart. I mean, Walmart's continuing to perform quite well. We like them. We like Costco. Those are two of the best companies out there in retail, so we like them a lot.
Joe Feldman, thank you, sir. I know you've got some calls to get on. Joe Feldman of Telsey Advisory Group on Walmart and Home Depot. Walmart, Lisa, just to go through the numbers again, seeing 2025 adjusted EPS of $6.70 to $7.12 a share. The estimate a little north of $7.
Also talking about potentially creating more robotics in their warehouses and automating more as they remodel. I'm just stuck on this data point. I really am. I keep thinking about this. Who owns everything that I do, right? I mean, essentially, at a certain point, these companies that know what I'm going to buy, where I'm going to go, where I'm going to buy coffee, how I'm going to respond to getting a paycheck. What do they do with that? Who do they sell that to? How do they advertise to me? How is this going to become a new model that's going to transform the way that I'm able to control myself when I want something?
And these are things that we've been thinking about for quite a while now. You asked the question about AI and he said better chatbots. Is that right?
Yes.
Is that what the future is? Better chatbots?
No, that's not the
retail.
future. No, the future is going to be, targeted everything. I don't even know what the future is. I'm trying to imagine it, and it's bleak.
They're just going to swipe your credit card before you even know about it because they know what you want to buy anyway.
You're going to just sort of look at the screen and it's going to buy things for you because it's going to have a sense of what's going on. I just am trying to reimagine where the revenue streams are going to come from, because if they could sell that data to an advertising provider, they cross a line, but then,
Sure.
They could potentially monetize that.
Can we finish on Walmart? Choiceful.
Yes.
What do you make of that word? The consumer's becoming more choiceful.
I'm struck by one of our guests who said they like to play down some of the expectations. At what point Sam Stovall was talking about they're really good at managing expectations. How much is this basically just trying to do that versus a more cautious sentiment that we're seeing in the retail sales that we got last week.
We've heard the trade down story for quite a while, haven't we? That speaks to this consumer that's not doing too well. Compare and contrast that to the labour market figures, which have been pretty robust still. A string of better than expected economic data out of the labour market for the last 6 weeks or so.
Yeah, but I keep going back to psychology. When you go to the grocery store, even if you're making more money, you still find it disgusting that you have to pay 15, 20, 30% more than you did 2 years ago.
I'm not going to name the store. I'm not going to name the store. You won't get me to name the store.
Does it rhyme with Rollroods?
No, this happened. No, it actually doesn't. This happened yesterday. A pack of cherries. I did not buy them. $20 for a pack of cherries.
Yeah.
Put them down and walked away.
But they would have been organic.
Absolutely not. I don't care how organic they were. I really don't.
Okay.
Live from New York City, equities pulling back on the S&P by 0.25%. On the Nasdaq 100, down by around about a third. Last week, no real drama at all. Pulled back just a touch in the face of yields repricing higher once again. Let's check out the 2-year. The 2-year yields up double digits last week. Yields this morning down about 4 basis points or so. We are down to 459, Lisa, 93. On a 10-year, down to about 426.74.
And this really comes as people price out the chance of some sort of recession and take a look at inflation just keeping benchmark rates higher for longer. Key question for me is, do we fully understand the inflationary impulse if we're getting it wrong with both CPI and PPI at a time of not the greatest kind of strength, at least not from retail sales?
What do you think about the City line from Andrew Hollenhorst moments ago? He's been talking about this now for a while. Soft landings are unlikely precisely because inflation forces the Fed to hold rates higher for longer.
It works as long as you believe in the transmission mechanism. But one of the big challenges has been the long and variable lags. So I'm curious about when that sort of kicks in. And that, I think, is going to be a continued debate. Is it going to materially shrink the economy to have rates higher for a couple extra months? I don't know.
Let's turn to foreign exchange. The euro, 108.05. Euro just a little stronger. Last week, another week of dollar strength. The rest of the world is really struggling. China is struggling to find a floor in its property market to stimulate demand all over again. The UK is contracting. Germany is contracting. Japan is contracting. The United States right now, Lisa, is not.
And how long can that continue at a time when you are seeing signs of weakness, but ultimately people keep talking about the fiscal backdrop, that people are still getting money and that money is still getting pumped into different kinds of technological advancements and different kinds of energy sources? And at what point does that either fade out or really become the big distinguishing feature with the U.S.?
And that's the big difference right now between the United States and the rest of the world, particularly China. Under surveillance this morning, your top stories: the U.S. proposing a UN Security Council resolution warning Israel against an attack on the southern Gaza city of Rafah. According to a draft text seen by Bloomberg, the text warning a ground invasion would see further harm to civilians and have, quote, serious implications for regional peace and security. Rafah's population has quadrupled in recent months, with more than 1 million Palestinians, Annmarie, seeking refuge in the city.
This is notable because the U.S. has been reluctant to back any sort of ceasefire for the past 4 months at the UN. I would note one line in this draft text, though. Such a major ground offensive should not proceed under current circumstances. I think it gives some of that pressure on Netanyahu to make sure that if they were to go in for a ground invasion, they do protect these Palestinians. And more on this week, because Brett McGurk, President's top advisor, will be in the region.
Another visit, I think, to Egypt this time, right?
Yes.
Yeah, one to watch through the week. Here's one to watch this morning. Earnings from Home Depot, the latest from them. The stock is sliding this morning after reporting a 5th straight quarterly decline in revenue. The company's CEO calling 2023 a, quote, year of moderation. Walmart also reporting this morning, offering softer guidance for 2025 and agreeing to buy TV maker Vizio for $11.50 per share. The deal will help Walmart expand its advertising business called Walmart Connect. The whole company, Lisa, as you've indicated, starting to sound and look a whole lot more like Amazon week after week, month after month, year after year.
At what point is Walmart a tech company? And we're talking about the shipping, we're talking about the different kinds of data and advertising.
They'd love this conversation.
Well, I mean, they're hiring more tech people than anyone else. Isn't this kind of the push that they're making? I'm struck by the diversity and size is the dominant feature in the successful ones. Home Depot is more hinged to the home building market and the home buying market, and they're suffering. Walmart isn't hinged to anything because they own the world. So at that point, they can sort of capitalize on whichever lever is being pulled at the moment in the economy.
I think they'd love that multiple as well on the stock, wouldn't they?
Well, they would.
Yeah, just a little bit.
They're aiming for it.
Just a little bit. Speaking of size, the size of this one, Capital One, agreeing to buy Discover in a $35 billion all-stock deal that creates the largest U.S. credit card card company by loan volume, the price representing a roughly 25% premium on Discover's last close. Capital One saying the deal will help build a payment network that can, quote, compete with the largest payments companies. The deal is expected to be completed by the end of this year or the beginning of 2025, pending shareholder and regulator approval. Annmarie, I think that was a dear regulator rationale for the deal, wasn't it?
Well, yes, Jonathan. When you look at what's going on in Washington, the FTC, the DOJ, 2021, they promised that they're going to look more carefully. They're going to be more aggressive when it comes to antitrust enforcement. So is there a potential that this deal doesn't end up going through because they're going to look at the credit card scope and say this is just too big a behemoth and it's going to ruin competition?
Without doubt, there is potential. It's all anyone's talking about this morning is can this deal close or not?
Yeah, but again, who is the competition for credit cards? Is it other credit card companies or is it a firm? I mean, at a certain point, if you have innovation, you just start to wonder whether the rationale just starts to be no, no, no. And then it raises this question, how much conviction can you have when there's a huge differential in antitrust policy between the two prospective presidents?
The antitrust policy issues, it's just open to interpretation all the time. And Lisa, I think that's the ultimate problem. If you do widen the scope, you broaden things out and start to take account of what's happening elsewhere with things like a firm, you get a different picture of things. If you sit there and just say, yeah, it's going to be bigger than Citi and JP Morgan and no one else competes, sure, you're going to end up with a very different picture of things.
This is the reason why Paul Taubman, when he was on just a couple of weeks ago, said that it's not going to be the M&A boom that so many people thought that it would be because of regulatory uncertainty. And this year is not going to be the year. Next year, maybe, when people have the certainty of what they're going to be dealing with. But right now, how do you really understand whether something's going to be stymied or not?
Particularly if there's a different person in the White House.
Exactly.
With a very different view on these kind of issues. Let's turn to the energy sector. A little bit of tension in the energy sector. Venezuelan President Nicolas Maduro threatening to bar ExxonMobil from expanding in Guyana. The oil giant is looking to grow development in the South American country's offshore reserves, expecting crude output to hit 1.2 million barrels a day by 2028. Venezuela has continued to make territorial claims about the region stretching back to colonial times. Joining us to discuss Exxon's big opportunity in the region is Liam Mallett, the president of ExxonMobil Upstream from the Guyana Energy Conference. Liam, wonderful to catch up with you, sir. I want to go back something like 10 years and start in late spring, I think May of 2015, when this discovery was first made by you and a team at Exxon. Liam, since then, can you give us some size and scope, just how big the opportunity is in this part of the world?
Yeah, Jonathan, thanks for the time and good morning to everyone. Firstly, I think, Jonathan, just a little bit of context, this energy concept, energy demand continuing to grow as the world's population grows and we continue to focus on lifting people out of poverty. And oil and gas, a fundamental component of that mix. And from our perspective, that will also continue to grow. But very importantly, at the same time as we continue to grow it, lower and lower the emissions intensity of that oil and gas. And nowhere, Jonathan, a greater example than right here in Guyana. This is a deep water. This is technology play at the extreme, out in 2,500 meters of water. And we've been extraordinarily successful in a very short time. You think about today we're producing over 600,000 barrels a day. That's gone from 0 to 600,000 barrels in 4 years. And the average development time from when we discover a well to actually bringing it online and putting that oil in the market is less than 5 years. That's about half the industry average. So, this is a country that is blessed with fantastic rocks, the rocks that produce the oil, a great partnership, great supportive government policies. We're doing it with lower emissions. We're spreading the benefits across the country. It is the kind of success, the kind of opportunity that comes along pretty rarely in a lifetime.
Liam, do you expect this to become the top producing country for Exxon outside of the United States pretty soon?
Well, I mean, it's certainly right now it's in our top 3 deep water developments around the world. And, at the pace that we're continuing to grow, Jonathan, over the next couple of years, it'll be right up there with the Permian in terms of the actual magnitude of the production. So very competitive, very exciting, and importantly, doing it with leading emissions intensity.
There's a real question about some of these security concerns, given the fact that there have been some serious threats from Venezuela's Maduro, talking about your exploration of the region. What kind of discussions do you have with the United States to ensure that your contract really gets enforced and that you're able to produce the amount of oil that you would like?
Yeah, well, we're staying very focused. We've been very clear. We're staying very focused on executing our operations within our defined contract area. That's what we've been doing. That's what we intend to continue to do. And, as we talked about, this development has many years ahead of it, and we're not going anywhere. So, fundamentally, we're delivering and we're developing and we're continuing to spread the benefits to Guyana within our area of operations. The matter for discussion with the borders is really a government matter, of course. We take the necessary precautions from an operational perspective, to the extent we can. But fundamentally, our focus is on doing what we say we're going to do, doing that within our approved contract area, and continuing to do that.
And that's the reason why we're talking about this, is because Venezuela's president was talking about barring you from exploring certain waters in particular that it was talking about near Guyana, right off the coast, that it claims as its own. Are you planning on exploring those areas? Is this a point of contention that you're talking to the State Department, or is that not in your purview and you can continue with the production that you have planned without that?
Those wells that got discussed are in our contract area, and we do plan on proceeding with them here in the coming years.
But are you concerned about Guyana's ability to defend itself? It's not just the rhetoric from Nicolas Maduro. It's the fact that we have seen in satellite imagery him building up his own military on the border.
That's honestly a matter for the governments. Clearly, given the nature of operations, we're informed as to the nature of those discussions. We've been pleased with the discussions. We're very supportive of Ghana's position that this should be resolved through the ICJ process, and we'll continue to stay engaged with them.
Liam, one thing that you mentioned earlier on in the conversation is the technology required to explore these deposits. Liam, I think that's really interesting, because if you go back to, I think it was 2018, when the IMF basically came out and said the terms of the 2016 deal between Exxon and the government and Guyana was too favourable towards Exxon, that the royalty share wasn't favourable enough for the government. Do you think the current situation, actually to go back in time, say 4, 5, 6 years, the current situation justifies that existing agreement?
Absolutely. This is a risk-reward business, and this was a front. You said it yourself, Jonathan. This was less than 2015, 9 years ago. This was a frontier, deepest water in the world type proposition that only companies with our kind of technology capabilities, our financial capabilities, could take on, and the contract was appropriate for that risk. And as we've continued to explore, we are successful in parts of the block. We are not successful in other parts of the block. So this remains a frontier area that is still very early in its exploration and its development stage. So this type of risk reward is very appropriate for the nature of what we're doing here in Guyana.
Liam, you've talked about developments like this helping countries like Guyana get out of poverty. Certain elements of the West, and you've seen this from policymaker after policymaker, government after government, want to phase out fossil fuels before Guyana and countries like Guyana have had the opportunity to develop the opportunity in front of them. Now, Liam, I just wonder your thoughts on that. And clearly, as an oil producer yourself, you're going to have to talk to your book a little bit. But, Liam, I do wonder what the government's been telling you about that. Do they have to do this quickly? Are they worried about how fast the timeline they've actually got to explore and develop this?
Yeah, I think it's the mixed question, Jonathan. Again, first of all, we are developing these resources with industry-leading emissions intensity. Secondly, we will be providing natural gas here, I think, as you probably know, to supply domestic onshore power generation here in the next year or so. This will get up and running. That in itself will halve the electricity costs to the people of Guyana and comes with significantly lower emissions than the alternative, which is imported fuel oil. So there is a whole value chain expansion potential from low emissions offshore oil to bringing gas into the domestic market and beyond, feeding a much lower carbon future for this country and allowing the country to grow and expand and spread those benefits into society at large, using gas as a low emissions source of energy and potentially other, alternative energies as the economy grows. But, the whole ability to get started and grow significantly and take gas and fundamentally transform the economy in a lower carbon way is right in front of our eyes and is something that the government of Guyana has been very clear about in their gas development plan.
Liam, we'll speak to President Ali a little bit later this morning. I think we catch up with him from that conference in about 45 minutes' time. Big question that we've been asking and trying to find out the ultimate answer to is when we can expect a final investment decision to proceed with a sixth offshore oil development in Guyana. Liam, how close are we to that decision now?
I will let you confirm this with President Ali, of course, but we're expecting to see that in the first quarter of this year.
Is that still the timeline?
Yes.
OK. Liam, appreciate your input this morning. Thank you, sir. Liam Mannon there of ExxonMobil. We will catch up with President Ali a little bit later on this morning. Fascinating time, Bramo, for this particular country, with a big dispute with Venezuela underway. If you go all the way back to the original find back in 2015, massive opportunity in front of companies like ExxonMobil. And then you get the IMF a few years later coming out and saying that that deal that they struck with the government of Guyana was too favourable towards Exxon. And then you have situations like this, where Venezuela is effectively building up troops on the border with the country, may have a war take place, who knows, some kind of military action at some point this year, starts to justify why it becomes such a high-risk opportunity for the likes of Exxon.
Venezuela's leader specifically went after ExxonMobil and said, do not drill in these areas. You are not allowed to. So it raises a question, where's the red line, right? And what kind of responses are going to be from the United States military to protect their right based on this contract to keep drilling there?
Well, the U.S. administration, Biden administration, has come out with unwavering support for Guyana. But when Admiral Kirby was asked about this specifically, because these satellite images were circulated, he says that their assessment has been that it's a very small nature, size, and scale at the moment. But obviously, this is something that is a concern. It becomes even more concerning when you see that companies are out there drilling and actually want to expand their exploration and business.
The president of Guyana joining us in about 45 minutes' time. Up next on this programme, regulators closing in on CRE risk.
The regulator has to do their job and understand what's going on in the market. And if there's heightened concern, scrutiny associated with a specific segment, they're definitely coming in and spending more time looking at that.
A conversation up next, live from New York. This is Bloomberg. Live from New York City, equities pulling back 1/3 on the S&P 500. Your bond market shaping up as follows. Yield's just about unchanged on a 10-year, 427.33 on a 2-year, down 4 basis points to about 460. In foreign exchange, the euro just a touch stronger against the weaker dollar. Stronger dollar through much of last week. 108 on euro dollar right now. Under surveillance this morning, regulators closing in on CRE risk.
The regulator has to do their job and understand what's going on in the market. And if there's heightened concern, scrutiny associated with a specific segment, they're definitely coming in and spending more time looking at that. But I don't think it's anything out of the ordinary versus what would have happened if there was more concern within another sector.
It's the latest this morning. Fed Vice Chair for Supervision, Michael Barr, saying the regulators are focusing in on commercial real estate loans, adding because of the heightened risk environment and heightened supervisory attention, the Fed has issued more supervisory findings and downgraded firms' supervisory ratings at a higher rate in the past year, also known as doing their job. Amanda Lynham, head of macro credit research at BlackRock, has been doing hers as well. Good morning, Amanda.
Good morning.
It's good to see you. Is the regulator on top of this in a way that they weren't, say, last year on a different issue?
I think the whole market is focused on it, including a lot of market participants, and clearly the public commentary from Chair Powell, Secretary Yellen has suggested that. I think for us, what we're really watching is, does this flow through to the broader system? Our base case is that we don't believe that it does, but that does not mean that there's more price that valuations that can reset. I think we do see more scope for that. This is a longer term process.
How truly idiosyncratic is some of this? If you take New York real estate, for instance, there are some loans, some deals which require rents to go up on certain buildings. You can't put rents up. You've got a big problem because rates are staying high. Is it very unique to, say, a place like New York, or do you see this right across the country at the moment?
It's idiosyncratic across CRE asset classes in terms of the categories, and it's idiosyncratic within. So New York is a great example where roughly half of the multifamily rent stock is rent controlled or rent stabilized. And so that really does prevent a lot of the flow through of the higher costs that we're seeing in the CRE market. I think for us, the issue is there are areas like industrial, hotel, self-storage that are actually doing quite well. There are areas like office that are well telegraphed. I think there's probably some more price reset to come there. And then there's multifamily where it's really geographical dependent. There are some regions where there's been a lot of overbuilding. There are others where supply is more well absorbed. And so it is very idiosyncratic, just like it's idiosyncratic with banks' exposures. So we know that banks on the smaller end of the spectrum have more exposure. The key will be, is this an earnings event or capital event for those banks? That's really key to watch. But as you know, the historical evidence shows us that this is a multi-year process to correct, and we expect that to remain the case this time.
There are going to be people who are listening to this who are going to be saying, we've heard about this for literally 2 years and nothing has really come to pass. I mean, there have been a couple of pitfalls, but it hasn't caused systemic risk. It hasn't caused small banks to cause some sort of wholesale failure. How do you place this in terms of your understanding of risk? Is this going to contract lending? Is this a priced-in known risk? Or is this an opportunity where you're starting to see pockets where you can buy?
Sure. Great question, Lisa. So two things. One is we haven't, outside of the idiosyncratic situations that have grabbed the headlines, we haven't seen major disruption, but we have seen loss reserves tick up. So large cap U.S. banks, for example, have reserved around 10% for realized losses in their portfolio. So that's a fairly draconian assumption. That would mean, just for example, a 20% default with a 50% recovery. So you have seen in the background office reserves tick up to around that 10% level. Overall, CRE reserves are in the kind of the low to mid single digits. So that is a good thing happening in the background. I would say on the lending side, bank lending remains tight, but it's easing, so it's not getting worse. So it's tightening at a more moderate pace. But CRE was the one area where the senior loan officer opinion survey called out as, in addition to auto and credit card loans, as expecting to kind of remain tight over time. So I do think that it is more challenging given the higher cost of capital environment in general for kind of interest-sensitive asset classes like this. But then you also have the structural advantages. Is there opportunity? Sure. I think at some point I would say there are investors probably in this space who argue there's opportunity now. We believe that there's probably some additional price correction to take place.
You said something really fascinating in your recent research where you said the key for corporate credit investors, just shifting gears a little bit, is the Fed's willingness to eventually cut rates proactively in response to improving inflation as opposed to potential weakness. This is the reason why we're talking here about risks and people are covering their ears and saying, la, 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 UBS strategists raising their S&P forecast. Everyone's sort of bullish because ultimately this is the end of the hiking cycle, the end of the peak, where this is peak rates, and we're talking about proactive cuts. How far does that get you to bullishness within credit that has already rallied?
So it's a great point. I'm not sure that 75 basis points will make or break any of these companies in terms of additional kind of financial flexibility. But what it does mean is that there's more clarity on the macro backdrop. And I think the fact that we're hopefully not getting any more hikes is probably what's critical for risk sentiment. The yield backdrop has been really important for corporate credit investors. And so a lot of investors that we speak to think that spreads are optically too tight. I would say the first observation is we've been tighter than this as recently as mid-2021 when yields were much lower. And then secondly, it's exactly the point you raised. It's a combination of a few things for risk. It's the Fed's signaling at the December FOMC that they're willing to cut proactively. It's lower quality borrowers' ability to tap the market, which we've discussed is a very positive signal in our view. And it's increased optimism on the soft landing. And so I think the combination of three of those things has actually boosted risk sentiment to a large degree, coupled with the fact that you can deploy capital at really attractive all-in yields. So I actually think we are often asked kind of, is the risk to spreads tighter or wider? I actually think it can be tighter. I wouldn't necessarily say that I would be surprised if we saw a little bit of widening from here. I would believe that would be a healthy correction, but I don't think it's out of the realm of possibilities that spreads could actually move tighter from here because that yield-based demand has brought out.
Should we talk about M&A as well?
Yes.
And how we're financing that M&A?
Right.
You've mentioned this before. Yes. Keep hearing all stock deals, all stock deals. We don't hear debt finance, debt finance. How important is that, just as a change?
Really important for credit investors in aggregate. And I should say that the funding mix, so whether it's equity or cash/debt, has shown variation over time. Part of that is a function of the interest costs. Part of it is a function of companies actually managing their capital structures. What we've seen this year is that it's been a pretty benign skew for bondholders, so a fair amount of equity or cash and equity funded deals. But it hasn't been entirely the case. Pharmaceuticals, for example, have been acquisition sectors that have had a lot of cash-funded deals ultimately replaced with debt. So it does matter to track the aggregate in terms of risk sentiment, but it also matters at the sector and idiosyncratic level. But in general, M&A is not always a bad thing for credit investors, I would say. Always great to catch up with you. Thanks for being with us. Amanda Lynham there of BlackRock. Bramo, I think the first thing you thought of over the weekend when this deal between Discover and Capital One was coming together.
Yeah, basically all stock. What do you think? Of course, no debt, right? I mean, Walmart's deal with Vizio may be debt, but maybe just all cash. But I think that Amanda's point there about it's not bad for credit investors is understating the fact, because if you look at certain companies, people are buying the debt because they think they're going to be taken out, and that basically they're just getting an option on that to get at basically at par after buying it at a huge discount.
Acquisitions that benefit credit holders and maybe not
stock investors. Yeah, this is a
possibly.
total shift, reversal of what we saw for so many years.
Not the ultimate objective, of course, but yeah. Maybe the consequence. Coming up on this programme, Peter Chair of Academy Securities, Ed Mills of Raymond James, and the President of Guyana, Irfan Ali. You're watching Bloomberg Surveillance live from New York. This is Bloomberg.
Be told, the economic data is still pretty strong. It's softening, but it's not weak.
Because the economy is slowing, but it's not recessionary.
But I think that there's some real stress under the hood of the system.
The confluence of data are all telling you this economy has more resilience.
Whenever we see something that's really surprising, take a deep breath, see what happens the following month, and don't dive into a premature conclusion.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Take a deep breath. Exhale. Relax. Was that therapy?
I think so.
From Ian Shepperson at Pantheon.
It basically has felt like therapy forever. Stop it with the cash. Put it into risk. Feel good. Take a breath. It's all good.
Nvidia will keep on rallying. That's what we've been told. That's what's been happening. That's not a judgment or a call about the next couple of days, OK? From New York City this morning, good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance. Equity futures on the S&P negative by 1/3%. Let's frame the week for you. Fed minutes about 24 hours away. You'll get some jobless claims on Thursday. A mini Fed meeting. You'll hear from speakers Jefferson, Bowman, Harker, Cook, Kashkari and Waller. And then the big one, Bramo, Nvidia, after the close Wednesday.
I was about to say none of that matters. It all is Nvidia. And basically this week is very much earnings front and center. What more can we hear from Fed officials that they haven't already said that's really going to change the needle? Right now, this is very much, can AI keep on AIing? Can we get the sense that Nvidia is going to rule the world? And at what point can they keep beating, or is this going to dent sentiment?
How many times have they beaten now by double digits and then raised?
Well,
and then we're sort of like the bar's getting higher. They keep on rallying by another 50% and they beat double digits and then they raise.
Which is the reason why I think a lot of people are expecting maybe we could get something different. And if that we do get something different, what does that do to sentiment? At a certain point, the hardware story has to shift to a software story. Right now, it's not. They're the hardware story. Everyone wants to hoard chips. At a certain point, you have to think people have the chips they need. Now they're going to start to use them.
Nvidia up by more than 40% year to date. The big winner again on the S&P 500. The broader price action looks like this on the S&P. We're pulling back by 1/3%. In the bond market, yields shaping up as follows on a 10-year Treasury yield at the moment. Yields look like this. We are going absolutely nowhere at 427.33. In foreign exchange, 108 flat on euro dollar. The euro stronger by 0.2%. Coming up this hour, Peter Chair of Academy Securities on downside risk in the market, Ed Mills of Raymond James weighing in on Biden's latest push for Ukraine aid, and Guyana President Irfan Ali on his push to make the country an energy powerhouse. That is a must-watch conversation a little bit later this hour. We begin with our top story, dialing back rate cut bets after hotter than expected inflation data. Peter Chair of Academy Securities seeing more downside risk than upside potential, writing this. The market is skewed heavily towards being bullish. Within that, it's extremely bullish on a subset of names. Between positioning and price action, the risk of the next 5% move being to the downside is much higher than the probability that we will go another 5% higher from here. Peter, I'm pleased to say, joins us right now. Pete, good morning to you.
Good morning.
Fed minutes or Nvidia? What matters more this week?
I think Nvidia is going to be the key thing, though I think Fed minutes is just going to be used as another tool to reinforce. Expect fewer hikes or cuts and expect them to be spread out further in time.
We've been pushing out these cuts off the back of hotter CPI, hotter PPI. If you look at the economic mix over the last week or so, we've been doing it for the wrong reasons, haven't we?
Yeah, it's kind of strange how this has all been working. And a month ago when we were at 7 cuts, I was at 4, thinking I was being a little bit conservative. Now I'm at 4, thinking, ooh, maybe I've got too many cuts priced in. And I think CPI is coming back, PPI is coming back. And to me, it's all going to hinge as the job numbers. Have they been true or not true? There are a lot of questions about the job numbers. If we really are seeing growth in the job market, these things make sense. If not, it's going to be sketchy and we'll start talking about recession again.
I was so excited to speak with you because you're a breath of fresh air after everyone's just saying we're bullish, we're more bullish, we're even more bullish, and any potential dip is going to be a buying opportunity. You see more downside than upside potential right now. But is that only going to be a buying opportunity, or do you feel that there is something materially different that's coming down the pike?
I think what we're going to see is kind of this cascading where people try and buy the dip, it fails and gets pushed lower. So I think we get this fairly dramatic in a couple-day period, maybe a 5 to 10% pullback. And what I was watching closely last week, when we even had those down days, what I saw was a lot of option buying. There was a little bit of option selling, puts buying, but most of it was skewed towards calls. So I think people had that buy the dip. It was rewarded. But as you started fading Friday, I think people have committed almost all their cash, heavily dependent on Nvidia. If something goes wrong there, I just feel this cascading sell-off, and you could get the zero-day expiration options kicking in a negative way.
So what does it mean for Nvidia to disappoint? Does it mean just beat a little? I mean, how big of a disappointment does it have to be to shift the entire narrative of a market?
That is very hard to tell, but I don't understand the company well enough to understand individual stocks. But I will say that whatever the earnings estimates are, expectations, I think, are way higher than that. So I think people are expecting a very, very good beat. And even if they beat, I just wonder who's turning around to buy. It could be one of those cases you get good numbers, it bounces right after the numbers, then everyone looks around, who's the buyer? Turns out no one's a buyer.
So we've seen upgrade after upgrade in terms of S&P 500 forecast, and it's come despite some of the higher yields that we've seen on the heels of fewer rate cuts getting baked into the market. There's a feeling that whether it's the AI boom or whether it's just the sense that we're at the early cycle, it's going to broaden out. Do you push back against that? Do you see something else that's going to kind of drive the cuts that's different than what's going to potentially be the reality right now?
So I thought retail sales was particularly interesting, right? The retail sales had kind of confused me why they were so good. We had some views that they were being pulled forward because sales were great in November, December. Brands that don't normally go on sale had pretty widespread sales. So all of a sudden you had this miss. And we track closely some of the credit card data. It's now well above trend. So remember post-COVID, everyone paid down their credit card, and it was rising quickly, but we are still well below long-term trends. We're above that. You're starting to see delinquencies rise. They're not at alarming levels. So if the consumer starts to roll over, then I think we go back to talking about recession and fears that. So to me, it's the jobs, consumer. That's what I think we're missing. And everyone's maybe being a little bit too optimistic on the other things, and those aren't getting the attention they deserve.
I'm listening to the words that you're using when you discuss the data. True or not true? Sketchy. What are you suggesting is happening here?
I think we live in this era. You can pick up your phone and know exactly where you're going to go. Everything's instant. And I think a lot of our data collection is old school. We're not sure how we do it. We do these surveys. Who knows what good data we're doing? And then they're trying to apply these analytics to the data, right, to do the seasonal adjustments. Who knows that their data is any better than ours, how they're analyzing it? So I'm just highly suspect. I would love to see a big spending program out of DC to revamp how we collect data so that people can make really good decisions based on accurate data in this world where everything's instant except our government data.
In the meantime, what's the lodestar then, given the fact that a lot of people have raised this? And before all the conspiracy theorists start saying, yeah, everything is manipulated, it's more that people aren't picking up their phones and they don't have landlines. So the number of people who are called is sort of a non-representative sample.
And you look at the Fed in terms of the jobs data, I think the survey response on the establishment is very, very low for the initial. It gets up to about 95% response by the time they do their adjustment 2 months later. But what good is that initial number when you're getting these incredibly low response rates? So I think we need to figure out a way to collect data better, more timely. And seasonality, I think, is tough to deal with at any time, but we've gone through 2008, we went through the European debt crisis, we've gone through COVID. It's a mess in terms of seasonality. So I think those adjustments are tricky too.
John was talking about Andrew Hollenhorst's note earlier this morning about how the reason why there isn't going to be the soft landing is because the Fed's going to have to hold rates as high as they are for as long as they are. Do you believe that there is going to be a more dramatic tightening that we experience in the next couple of months?
One of my beliefs when I thought we'd have 3 cuts this year, May, June, July, 25, 50, 25. I'm probably going to dial back on that. But part of my thesis was the Fed is not going to want to cut in September or November because it will look like an election manipulation issue, or certainly be called out by Trump as such if he's the side. So I think they're going to have to be very cautious about what they do in and around the election so they're not in any way portrayed as affecting the election outcome. So if you take September and November off the table, yeah, maybe you only get 1 or 2 cuts and that's it.
Do you think that weighs on them? You think it actually weighs on Fed officials?
I don't think that they want it to, but I think it's going to be very difficult in this day and age where many more people are talking about monetary policy than I remember certainly 8 years ago.
Yeah.
Social media makes it easier, and everything now seems to divide very quickly into 25% hate it, 25% love it, and 50% are maybe agnostic, but you get instant hate or love. So I think it could become just horrible for them to have to deal with. I don't think they want to deal with it, but sometimes you got to be cautious.
Should we talk about something that's horrible to deal with and no one wants to deal with it? The deficit. You think this is going to take on greater importance as the year progresses. Why do you think that returns as the issue?
Well, one, you start seeing articles about it again, too. So everyone quieted down about that. And when this was coming out, and we got very bullish at 5% on 10s towards 4%, part of it was people were, jumping ahead and talking about supply like it was going on forever. They were talking about, the average coupons rise. All those things take time. Now it's 6-8 months later, the supply is still rising. The average coupon is slowly ticking up. I think that's going to come back to the forefront, and I think the election's really going to spur that, because my estimation is you're going to, one side say, well, we're going to do massive tax cuts, but that's not going to affect the deficit. The other side's going to say, we're going to do massive spending, but that's not going to affect the deficit. And the markets are going to start realizing this deficit's going higher. And the other part of this, we are all worried about foreign buying. China's not buying. China's continuing to slow down. As China has to defend their own markets, their use of treasuries is not going to be to buy more. It's going to be dwindle that to help their own economy.
AMH, no one wants to fix it.
Well, if you fix it, you have to talk about entitlements. And that is the third rail of politics. And no one is going to try to campaign on, I'm going to cut Social Security and Medicare.
How's that going for Nikki Haley?
I mean, she's talking about it.
Whispered it a few months ago and then kind of whispers it even more quietly now.
With us, she said that 65 was way, way too young. And then she wouldn't say that number again because she's already getting hit on it. She's talking about it, but she's not going to be the nominee. And the issue is no one in Washington wants to talk about this because it means serious cuts to entitlements or a reestablishment of how these programs work.
Good policy, good politics, Bramo. Two very different things.
You're just trying to wind me up. I know.
Just a little bit.
Just
honestly,
trying to get
you going.
My thing of it, Peter just said, is that everyone's going to realize that the deficit's only going higher. We realize it now. Here's the thing. It's not like this is sort of an unknown. It's just sort of you put a spotlight on it and suddenly people worry about the auctions again.
And one thing that I think will be easy for people to point to is as interest expense becomes a bigger line item, that's going to stick out very starkly. And that's something no one can defend.
And Chair Powell said on 60 Minutes, it's urgent. He normally wants to stay very far away from fiscal issues, but he said, yeah, I would characterize it as urgent matter.
Peter Chair, you'll be sticking with us, I'm pleased to say. Let's get you an update on stories elsewhere this morning. We can do that with Bloomberg's Danny Berger. Hey, Danny.
Hey, John. California is still grappling with extreme weather in another atmospheric river. The National Weather Service warns of difficult conditions through Wednesday after an expected lull today. LA and San Diego are at risk for significant flooding. 5 inches of rain is predicted for some areas. The storm is expected to pass through quicker than the one earlier this month. Shares of Home Depot are lower in the pre-market trade. The company posted a 5th consecutive quarter of revenue declines. The company saw fourth quarter comp sales lower by 3.5%. High mortgage rates and a slowdown in construction underscored the demand for home improvement. In a statement, CEO Ted Decker said, quote, 2023 was a year of moderation. Capital One has agreed to buy Discover Financial. It would rank as the biggest global deal of the year. It's a $35 billion all-stock agreement, and it would create the largest U.S. credit company by volume. Capital One will be paying a 26.6% premium to Discover's close on Friday. The deal is expected to complete by the end of this year or the beginning of next, pending shareholder and regulatory approval. That's your Bloomberg Brief. John.
Danny, thank you. Coming up on this program, up next, the White House intensifying efforts to secure aid for Ukraine.
I think there's plenty of path for Ukraine aid to get passed in Congress. 3/4 of the House is in favor of Ukraine aid. It is much more likely than not that this happens.
That conversation coming up next, live from New York. This is Bloomberg. the mic up? There it is. 1, 2, 3, Magic TV. Under surveillance this morning, the House intensifying efforts to secure aid for Ukraine.
I think there's plenty of path for Ukraine aid to get passed in Congress. 3/4 of the House is in favor of Ukraine aid. It is much more likely than not that this happens. There are a variety of processes to make it happen, from a discharge petition to a suspension calendar to even regular order. But I do think it's likely.
It's the latest this morning. President Biden saying he's willing to meet with House Speaker Mike Johnson in order to pass the $95 billion foreign aid package. Pressure building to pass aid for Ukraine following the death of Russian opposition leader Alexei Navalny. Ed Mills, Washington policy analyst at Raymond James, joins us now with a long list of things to get through. Ed, before we get to foreign aid, I want to talk about the prospect of a big deal between Capital One and Discover. From your perspective, Ed, and you're perfectly positioned to talk us through this, how likely is it that this administration gives that deal the green light?
So, John, what's fascinating about this is that we've been in conversations with lots of contacts here in D.C., and they told us about the top deal that could get done is about $100 billion in assets. Now, Discover's 140, Cap One's about 500, so much greater. The reason why they've been telling us that is A, the bank panic of last March, but also OCC, which is the primary regulator of Capital One, has just put out new kind of guidance on regulations and asking for kind of comment. The Department of Justice is asking for comment on what they want to do with bank mergers. And so I think trying to get this done by the end of the year or early next year, unless President Trump is reelected to a second term, this is going to be very difficult from a regulatory perspective to get done in that time period from where I sit.
Well, is it this new rules that they're trying to finalize the issue, or is the U.S. election a potential issue that could drag down this deal?
Yeah, Annmarie, it's really interesting because Basel III Endgame, which is what the Fed is calling their new capital rules, do have kind of higher standards for banks above $100 billion, driving some of that consolidation. We've said, if you go through with this, what you're going to see is more bank consolidation, because the closer you are to the lower end of that spectrum, the more costly it's going to be and the more likely you're going to need to have that consolidation. There's a couple of things in there. If you have a credit card network, higher capital charges. If you have a lot of credit cards, as a general rule, higher capital charges. I think those probably have to get changed in the final rule, but that could be driving this conversation. What's really fascinating is what could also be driving this conversation is on the Hill, there's been a push to say for credit card issuers, if you are above $100 billion in assets, you have to use a network that's not Visa or MasterCard. Discover was looked as the winner there. Now, that bill has low odds, but it could be part of a pro-competition angle that they would say, we're not really a bank, we're a credit card company with this network, and that's why you should get us approved. So that's going to be the push and pull this year, is how much we look at it as a network versus how much we look at it as a bank.
Ed, can we talk about a little about the timeline when Congress gets back? They have 2 to 3 days to fund the government in the first tranche that needs to be funded on March 8th. Do they get this done? Do we see a CR, or is there higher risk of a government shutdown?
Yeah, Annmarie, I think the honest answer is I don't know. You're right. We have the House and Senate out this week. The House and Senate come back next week, but the House only comes back next Wednesday, 3 days before that March 1st deadline. We've had members of the House leadership say there's not going to be another CR. So it's really hard to see how you're going to be able to get the finalization of those 4 appropriations bills with deadlines on March 1st. Is it possible? Yeah. Or could we also see a partial government shutdown, building up that crisis moment, trying to get something done before March 7th, which is the State of the Union address, or March 8th, when the other 8 bills and bills that have a bigger impact on the economy and on government, quite frankly, the Defense Department, Health and Human Services, that's when those bills are done. So I think that we're not going to have a prolonged shutdown if we're there, but could we have a building up of a crisis leading up to those 2 other events that are really important in D.C.? That's totally possible.
So put that to one side. That's just funding the normal government. What about the foreign aid bill? This has been a stalemate in Congress. President Biden said he's willing to meet with Speaker Johnson. Does that show fresh impetus to get this over the finish line? Yeah, so Speaker Johnson asking for that meeting with Biden, the
homicide of Navalny, the kind of concern about Russia in them putting a nuclear weapon into space. All of this is building up pressure. What I normally am looking for is that when you know you're going to get jammed, and I do think Republicans in the House are going to have at least have a vote on this, and if there is a vote, it passes, you're usually looking to see what else could I get done. Now, the House last week before they left, they voted to overturn President Biden's LNG kind of ban for the next couple of years with the new studies. I would normally be saying, all right, let's get that added. Let's get a border bill in. The problem for Speaker Johnson is that the more he's seen as negotiating this, the more his speakership is in doubt. And so he'll probably have that meeting. But I think ultimately where this gets done is through some sort of parliamentary pressure that a vote happens maybe against his will through a discharge petition, through defeating a rule and kind of moving to a previous question with this bill alone. So I think it gets done. It's just a question right now. The politics has to play itself out before we figure out what is that mechanism. But I do think by mid-March, we will have this aid package signed into law.
Just taking a step back, Ed, it seems like from a market's perspective, there are three buckets in D.C. There's the regulatory uncertainty, which we see with mergers and acquisitions. There's a deficit, which we were just talking about with Peter Scheer, and how much it's increasing as we continue to finance a whole host of issues. And then there are geopolitical risks. Which of those three do clients ask you most about, or most relevant to their investment thesis?
Yeah, Lisa, it really depends upon the client. So we have a large private client group. And when I go and present at Raymond James to those groups, we talk about all of it. When I'm talking to a portfolio manager that's global, geopolitical risks come in. When I am in Europe, more of that debt and deficit conversation comes into play, partly because if you want to be part of the EU, there is caps on the debt and deficit. But when I'm sitting and talking to a bank investor, which I'm going to spend the rest of the day talking to bank investors about this Cap 1 Discover deal, they want to know about regulatory risk. They want to drill down into Basel III Endgame, the CFPB's credit card late fee rule. So I think for me, it just makes for a really interesting job and lots of conversations to have. DC is probably at its max right now, and it's probably only going to get more interesting as we get through 2024.
Looking forward to these regular conversations, Ed, about these issues. Ed, thank you, sir. Ed Mills there of Raymond James. Peter Scheer of Academy Securities with us around the table. Pete, let's talk about what's happening on the international stage at the moment. Clearly some tension in the Middle East. Some tension continues in Ukraine between Russia, Ukraine, and arguably the rest of the world. You have a more constructive view on the endgame to this going through 2024. Where does this one end up?
Yeah, so we look at it, we have 18 retired generals and admirals who serve as our geopolitical advisory group at Academy Security, so I tie a lot of this into it. So to be quick, I think in the Middle East, we're watching very closely for anything that forces us to acknowledge Iran's actions and start clamping down on their oil sales. They're selling about 3.5 million barrels of oil per day, mostly to China and India. That's helping lower global oil prices. We've turned a blind eye to that. It's well above the sanction levels. So anything that forces that, I think, could be on a tactical level very bad for markets. You'd see oil spike. You'd see a lot of concerns. When we look at Russia and Ukraine, we see this drifting towards some sort of truce or peace, whether it's before or after the election is tricky. I think it's going to depend a little bit. If it looks like it's a close election, both sides may want to say, let's not take what happens in the election, let's come to some sort of truce. I think the big bargaining chip that people aren't talking about very much is we held back a lot of Russia's dollar reserves. That will probably be a big bargaining chip in terms of Ukraine, you take $2 trillion, Russia, you give $2 trillion, we all go away. So that's kind of where we're leaning. I think it's actually going to be very inflationary, though, for Europe if we get that. I think that's the opposite.
Well, do you think that just generally that all of these types of geopolitical risks become inflationary because people are going to be spending more on military, people are going to be spending more and more generally, and you have potential commodity risk? Is that part of why you're more negative?
Yeah, and also if you do get rebuilding in Ukraine, you're going to have an immense amount of commodities used to do that. You're going to have to hire people. You're going to have to convince people to move back to Ukraine. So that's there. And in China, our big view, or my big view, has really been that we're in this shift from made in China to made by China, where China's going to go from manufacturing our brands to trying to sell their brands globally. A year ago, people looked at us like, that seems insane. And now you're watching the progress BYD, some of their phone companies are making.
You see it everywhere.
And I think they're going to go aggressively after the emerging markets. and then maybe into Southern Europe as kind of the weak points where they need those, discounts. And so I think that's going to be the big shock to the system is China goes from being this kind of manufacturing hub of our products to trying to manufacture and sell their own. And that we're not prepared for. And I got a big boost when Elon Musk was clearly worried about something like that.
Yeah, governments might have other ideas. We'll see how that works out. Peter, thank you, sir. It's good to see you. Peter Cheer of Economy Securities, BYD, Latin America, BYD, to Peter's point, Italy and elsewhere.
And this means that they're not going to necessarily be producing things cheaply for companies that are in the U.S. or in Europe. And that means inflation, and that means potentially some real questions about tariffs.
Up next on this program, don't miss this, the president of Guyana, Irfan Ali, joins us from the Guyana Energy Conference on his nation's big opportunity in the energy sector. Live from New York City, about 60 minutes out from the opening bell. Equity futures negative here, 0.4% on the S&P and on the Nasdaq 100 too. In the bond market, yields shaping up as follows. 2-year, 10-year, 30-year. Look a little something like this. Your 10-year yield is unchanged at 428.12. The 2-year down 3 or 4 basis points to 460.57. I'll get to foreign exchange, then we'll turn to energy. And FX right now, the euro looks a little something like this. Euro dollar 108.08, positive there by about 1/3%. Turning to energy, Guyana is calling for the immediate development of its gas resources to make the country a regional energy powerhouse. Exxon, which discovered oil in the country back in 2015, is ramping up production fast and aims to produce 1.2 million barrels a day by 2028. Venezuelan leader Nicolás Maduro may have other ideas as tensions continue to rise over a border dispute stretching back decades. The president of Guyana, Irfan Ali, joins us now from the Guyana Energy Conference and Supply Chain Expo. Mr. President, thank you for being with us, sir. Let's talk about that tension first of all. You've indicated over the last few months that Venezuela has been building up a military presence near your border. Maduro has not denied that claim. Maduro and the Venezuelan government have issued a warning to Exxon about developing this opportunity in this particular region. What kind of assurances are you offering to foreign companies operating in your country?
Well, the greatest assurance that we can offer is that Guyana is sure of its territorial integrity. We are sure of our borders. And in 1899, our borders were settled. Venezuela participated in the settlement of those borders. So there is absolutely no doubt as to where our borders are. A controversy was raised by Venezuela decades upon decades after, when we were going to independence. And that controversy is before the ICJ. We are a country that respects the rule of law. We are a country that abides by international law. And that is why we respectfully ask Venezuela to participate and be a member, a responsible member of the international community, and to respect the outcome of the ICJ. But we don't, we are very sure of our case. We are very sure of our borders. And investors need not to worry because their investment are clearly in the territorial space of Guyana.
I'm sure they have their own worries, sir, and they can talk for themselves. I'm wondering from your perspective how closely you're working with the US State Department and what kind of assistance they've already offered so far to you.
So we are working with not only the US State Department, we're working with many of our regional and international partners. For a matter of fact, in the region itself, CARICOM has reiterated its support for Guyana, its respect for Guyana's territorial integrity, and also called upon Venezuela to participate in the ICJ process and to respect the outcome of that process. So too does our neighbor Brazil, France, Canada, the UK, the US. Most of the international community has and is in support of Guyana, knowing the fundamental facts and the truth. And that is our borders were settled in the 1899 arbitral award.
Experts say that the imbalance for the military between Venezuela and Guyana is 100-1. Yes, you're talking to your partners, but are you going to be building up your own defense capabilities?
So we are doing a few things. One, we are investing in the modernization of our military, in the advancement and use of technology. in the building up of our human capacity, our infrastructure. But more importantly, we're working closely with our allies. We're working closely with the US, with France, with the UK. We have many training exercises that we're conducting together. We are working with the regional security system. So it is not only what exists within the country, it is also our work that we're doing in the international community and our partnership with our allies and friends.
The U.S. has said that this assessment of this military movement that Maduro has on the border is very small in nature, size, scale, and scope. Do you agree with that assessment?
Look, we believe that any threat of our territorial integrity, any threat on our borders must be taken seriously. And that is what we're doing. We're taking this very seriously. We are working with Venezuela now and through CARICOM to ensure that this does not escalate, because our primary focus is to ensure the region remains stable and the region remains peaceful. That is our primary focus. Our primary focus is to ensure we do everything to promote that stability and peace within the region. But in our assessment, there's a lot of assessment on Venezuela and their capacity and capability and what is driving this claim. But for us, it is a threat, and we're taking it seriously, and we're ensuring that we do everything to secure and protect the territorial space of Guyana.
Mr. President, how important is it? How much urgency do you feel to monetize the oil and gas reserves in Guyana now before there is some sort of significant transition away from fossil fuels?
Well, I think bar the transition, because we have to look at transition too. We still have 36% of the world's energy coming from coal. We still have tens of millions of people around the world who are living in energy poverty. The technology on transitional energy source is still not there to give us competitive transition. The capital cost of the transition is enormous. Developing countries are having great difficulties. The supply chain of the technology required for transition is still not at capacity. So there are a lot of challenges on the transition side itself. And we are all for the transition. We are all for cleaner energy, greater use of renewable. But that I just want to make that point, that the transition timetable has challenges by itself. Notwithstanding that, we understand that we must, in an expeditious, safe, and sustainable way, also develop our oil and gas resources. So I think that the time to develop is now. The time to advance our production is now. The time to monetize is now. And that is why we are working aggressively on moving from discovery to operation, but also, importantly, moving now in an aggressive way to develop the gas resources of Guyana and to integrate the gas resources into our other sectors so that our other sectors become competitive, and using the gas resource as a tool to build out the infrastructure, capability and capacity of the country, into connecting the country more integrally with Brazil. Because once we develop the gas resources, it opens up the opportunity of justifying the deepwater port in Guyana that can serve all of northern Brazil, and building out that infrastructure to link northern Brazil to the Atlantic through Guyana. That will save many days in shipping time, make northern Brazil more competitive, reduce their shipping costs, improve their infrastructure link, and advance their competitiveness. That also allows us now, that natural gas allows us now to move to value, upping the value chain for our bauxite, which is a natural resource, because we can now use cheaper energy to develop an aluminium plant with 1.5 billion tons of bauxite reserve between Suriname and Guyana that can now be transitioned into aluminium and a higher value market. That also helped to justify the building out of a deepwater port and the integration of the infrastructure. So this is how we're thinking about it, not just the expeditious monetization of the gas, but how we will use that gas to build out and widen the economic base and bring in new opportunities for the country and the region.
Mr. President, when you talk about urgency, is there still the timeline that we heard from Exxon first quarter to approve their sixth deal with respect to oil?
Well, we are examining that right now. The technical people are looking at it. So that is a technical assessment that is being done, and we are working to move it rapidly as possible, but also ensuring that it meets all the conditions and satisfy all the requirements.
You're going to be one of the foremost players potentially in this sector in 2030, something that is new for your country. How concerned are you about inflation rising within Guyana?
Well, we are working on ensuring that the economy is not dependent on oil and gas, but all the resources from oil and gas is used to build out the other segments of the economy, making us more competitive. What we want to do is to position Guyana as a global leader in three areas: energy security, because of what is available to us and the role we can play in the region; food security, because we have competitive advantage in the production of food, arable land, huge reserve of fresh water. So we want to be the leading producer of food in the region. And thirdly, on climate, we want to be a leader on climate because we are already providing global leadership on the forest. We have the lowest deforestation rate in the world. We have a forest the size of England and Scotland combined that stores 19.5 gigatons of carbon. We already have most of the forest at jurisdictional scale carbon certified, ready for sale on the voluntary market. So those are the three things that we are pushing aggressively, filling out our human resource capacity. And all of this help in taming inflation and ensuring also that we invest wisely. We don't drive the economy into overheating the economy. We don't build beyond what is required for the development and advancement of our country, that we have strong fiscal policies, that the resources coming out of oil revenue goes directly to invest in areas that will grow the country, strengthen our human resource base, and support the socio-economic development of the country, and also save for the future. So these are the things that we're doing. So we're not concerned. If you look at our inflation rate in the last three years, you will see that it has been very stable, the lowest in the region.
Just want to finish, Mr. President, on incentives for foreign companies to develop these natural resources. Quite clearly, this is still considered a high-risk investment for many companies that have the technology that you require, including the likes of Exxon. You'll remember a number of years ago, I believe back in 2018, the IMF criticised the terms of the deal originally signed back in 2016 as being too favourable towards Exxon, that the royalties being offered to your country were not high enough. I just wonder, going forward from here, given the situation with Venezuela, how difficult it's going to be to demand higher royalties from some of these companies.
So we have already said that the agreement with Exxon and the Stabroek Block, yes, we have said this, that it was highly slanted to Exxon. We have already changed the PSA. So the new PSAs will be far different from the one Exxon would have benefited from in Stabroek Block. We have made this public. So the PSA is striking a balance because, as you rightfully said, this is an industry also that has its own difficulties. Raising capital for exploration, the cost of is difficult. The cost of that capital for investment in oil and gas sector is higher. It's not only limited, but the cost of that capital is higher, which is driving up the cost of operation, which is driving up the cost of exploration. So all of these are difficulties that the industry is facing and will continue to face. So we have to ensure that we have a PSA that strikes the balance, that gives the country, give us the best returns, but at the same time does not work in a way that drive away investment. So in the recent auction that we had a PSA that was shared among all those who participated in the auction, and that also we are continuously looking at, not on the fiscal side, but more on the conditionalities and guidelines. So you're correct. The future PSAs will be far different from that Exxon got on the Stabroek Block. Yeah. But that difference would not be to the detriment of investors.
It's a difficult balance to strike, I'm sure. Mr. President, thanks for being with us today. President Irfan Ali there of Guyana on the opportunities and the risks still ahead for that country to develop what is a massive opportunity in natural resources.
Absolutely. It would change the landscape, really, of the energy map when you look at how much they are potentially able to produce in the next few years. But I'm really struck about his tone when it comes to Maduro's troop buildup on the border. The U.S. says this isn't very big in size and scope. Clearly, he's concerned about it. James Stavridis talked about in an opinion piece in December about how Maduro is actually using Putin's playbook when he was bordering up on Ukraine in Donetsk and Luhansk. And potentially that's what's concerning here because this is so resource rich, this land that he's fighting over.
It's one to watch for Exxon and others too. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. China is ramping up support for its troubled property sector with its biggest cut ever to a key mortgage reference rate. The PBOC announced that lenders will slash their 5-year loan prime rate by 25 bips to 3.95%. The move marks the country's first cut since June and shows an increasing focus to combat the property crisis. The U.S. has proposed a UN Security Council resolution warning against an Israeli assault on Rafah and calling for a temporary ceasefire. That, according to a copy of the draft text seen by Bloomberg. So far, the Biden administration has been reluctant to take steps against Israel, but frustration with Benjamin Netanyahu's government is growing. President Biden says he is willing to meet with House Speaker Mike Johnson to discuss a $95 billion emergency aid package for Ukraine and Israel.
We're making a big mistake not responding. Look, the way they're walking away from the threat of Russia, the way they're walking away from NATO, the way they're walking away from meeting our obligations, it's just shocking. I've been for a while. I've never seen anything like this.
The White House is ramping up its push to pass the bill after the death of Russian opposition leader Alexei Navalny and the recent fall of Ukrainian city. That's your Bloomberg Brief, John.
Danny, thank you. Up next on this program, Capital One agreeing to buy Discover for $35 billion.
You've got a couple of weak or weaker competitors that are trying to get together for strategic reasons, for survival. I think you need to look at that closely as a regulator.
Two stocks to watch going into the opening bell. We'll talk about that next. Live from New York City, this is Bloomberg. We are about 42 minutes away from the opening bell. Equities are lower here by about 1/3% on the S&P. We're totally unchanged on a 10-year, 427.92. If you go into the bond market and take a look at the 2-year, we're down about 4 or 5 basis points at the front end of the curve. A break of 460, about 459 on a 2-year this morning. Under surveillance this morning, going into the opening bell, Capital One agreeing to buy Discover for $35 billion.
You've got a couple of weak or weaker competitors that are trying to get together for strategic reasons, for survival. I think you need to look at that closely as a regulator. Regulators haven't minded the duopoly between Visa and MasterCard. So I don't understand why this is, would be a huge issue. So, I mean, I'd hope they'd be able to see past that.
Is the latest. Capital One agreeing to buy Discover in an all-stock deal. The deal sets the stage for the largest U.S. credit card company by loan volume and is expected to be completed by the end of the year or early 2025, pending regulator approval. Joining us now to discuss is Bloomberg's Sonali Basak. Sonali, great to see you.
Good to see you.
Let's start with the rationale for the deal, and then ultimately that's going to turn to the regulatory stuff. What's the big rationale for this deal?
Well, there's two things here. One, it really increases the scope of the deal. You have a large company that can get a lot of synergies. Remember, this is a company, Capital One, that has $20 billion worth of non-interest expenses alone. So to save a lot of money on marketing, on technology, could really add a lot for them by buying Discover. It also adds a network. Remember, Capital One is an issuer, whereas you have Discover that is a large network as well. So it really gets you inside of the plumbing of the credit card industry for Capital One to buy Discover that they don't have, reducing reliance on Visa and MasterCard.
Often in the press release that they put out is really just a letter to the regulator. Dear regulator, this is why this deal should close. What do you think is going to be the difficulty this year?
Well, one thing you have to remember, they have changed a lot of the guidelines when it comes to bank mergers. And so they waited until the OCC and the Fed and the DOJ came out with those new proposals. So you have to understand that they have a certain degree of certainty, that those overlaps don't exist pertaining to the new guidelines for these regulators here?
Well, this raises this question of what would the rationale be then for regulators? Because we're looking at a premium, if this were to go through, of more than 20% for Discover. Those shares up just north of 12%. It's a pretty hefty discount for this not going through. What's the main obstacle at a time where they're not that strong in terms of players and they're facing off against a pretty strong set of banks?
They highlighted that network capability for a very specific reason here, Lisa, because if you take just the loan volumes by themselves, you have the number 3 and the number 6 company merging. So that would make it the number 1. But you're not talking about JP Morgan and Citigroup merging. You're not talking about 1 and 2 getting bigger. You are making Discover bigger, is really what you're doing in this regard, and helping them compete with the banks. The network, you have Discover a lot smaller than Visa and MasterCard. So while they're highlighting the network, they're really starting to highlight something that Discover is way lower down on the totem pole here to give them scale to compete with 2 and 3.
It also raises this question around Capital One traditionally doing a lot of business among lower income families, a lot of subprime loans in a whole host of different categories, and Discover being more prime and uniting the two. And there's a real question of whether this is a cyclical play, about whether this is something that other banks are trying to get into in terms of credit cards at a time where those outstandings are going up, or whether this is sort of protection against the downside.
Yeah, and that's one of the greatest questions. Right before I came here, I tried to take a look at just how different they are. And you have Capital One with almost a third of their customer base here, looking at FICO scores of less than 660, where that's less than a fifth for Discover. So really, they are really rounding out their base here. Now, if you're a regulator, what you might ask is, what does that mean for the people with FICO scores under 660? You start to worry there about what the consumer base looks like. We already know Capital One has been starting to inch higher on the more luxury, more well-capitalized segment of Americans and consumers. But what then happens for those folks who are being left behind in the system?
It's a major question. We've talked about, I think it was Bank of America, wasn't it, when we talked about just how strong the consumers that they serve actually are.
Yeah, it's interesting. You have most Americans have FICO scores well over 700, right? And you have had a lot of these banks starting to shed FICO scores. You're going to have, if you have 2 large credit card companies like this merging, a worry here about what happens on the lower end of the spectrum. Guys, you have to think about the macro backdrop here as well, because they're doing this at a time where many companies are already tightening standards. So if you go back over the last decade, you have kind of historically tighter standards today than you would have had in 2021 and 2022, and even in the period leading up to the pandemic.
What's your big takeaway from the deal activity we've seen so far this year? A lot of it's been all stock deals. Any big signal there for you?
Well, one thing is you have the winners and the losers, right? Remember, there was a divergence between Capital One and Discover here because Discover had their stock really lagging behind because of those regulatory issues. And so if you have stock that is worth enough to buy somebody that is lagging behind a little bit, now's the time to pounce because of that divergence. Plus, the regulatory picture is becoming more clear.
We're seeing a lot of that. Shonali, thank you. It's good to hear from you. 2 stocks to watch going into the opening bell. Coming up tomorrow, just a snapshot, a sneak peek of the lineup for you. John Stolfers of Oppenheimer Asset Management, Mike Schumacher of Wells Fargo, Binky Chadha of Deutsche Bank, and the Marriott president and CEO, Tony Capuano. Looking forward to all of that. Lisa, 2 upgrades. One from Goldman on the S&P 500, another from Jonathan Golub over at UBS in the last couple of hours.
Yeah, talking about potentially increasing it beyond the 5,200 even, that a lot of people are calling for. You have to wonder exactly what's behind this. Is it the big 7, the magnificent 2, whatever you want to call it? Is it them that just continue to drive this, or is it the broadening out that people talk about? It's kind of key in terms of the economic backdrop and rate cuts and how that plays out.
The dominant one. What did you call it? Nvidia? What did you call it earlier?
I forgot.
Earnings coming up after the close tomorrow.
Oh, outstanding.
The outstanding
one.
Up more than 40% already year to date after just absolutely rocketing through last year.
It's like the golden child. It's like the one that everyone kind of hates, but they also kind of aspire to be.
The siblings hate?
Yes, the siblings.
But the parents love? The parents in this analogy, the investor? Is that where we're going with this?
I was going to try to go there. Royalty. And then I'm quickly cycling back and let's move on.
I just wonder how important Federal Reserve policy actually is. I keep going back to the price action in last week. You push back rate cut expectations further off the back of hotter CPI, hotter PPI, which is the bad reason to push back rate cuts. And then equities fell by what? 0.4%, 0.5%? That's nothing.
The big mystery for me, honestly, is just where we are in terms of neutral. If 4% is the new neutral, that will be a very different reality for people who say that companies can exist at that level, but the Fed's not going to cut that much. That's not going to turbocharge certain fixed income investments, but it will allow certain equity investments to do okay.
Matt Lizzetti, chief US economist over at Deutsche Bank, on top of that story. Federal Reserve minutes coming out tomorrow. Look out for that. Just how much agreement or disagreement division was there on the FOMC? Given how uncomfortable Chairman Powell looked in that news conference, trying to reflect the consensus or lack thereof on the committee. I have to say that since we've heard from Fed officials over the last few weeks, they seem pretty in line with each other. So I'm wondering what was going on in that press conference.
It's a good question. It sort of raises this issue. Are they basically saying the same words but having a different meaning behind them? Seriously, it's sort of, when you're talking with somebody and you're speaking a similar language, but when you dig a little deeper, you're actually talking about something different. I wonder if that's sort of the measure of how to get, sort of to that level where they're ready to cut.
I think we hear from Bostic tomorrow morning. Then Thursday, if you missed it, the lineup for Fed Speak: Jefferson, Bauman, Harker, Cook, Kashkari and Waller. So basically the whole committee. From New York City, equity futures slightly negative. We're down 1/3 of 1%. Your opening bell about 34 minutes away.